Hello champions, I hope you are doing really well. So I had launched the ForeQast series very recently, you must be aware of it. The series where I had shared with you all the list of your last day revision questions, your expected questions, the highly predicted questions, questions which are testing you on those concepts where you generally tend to make a silly mistake, or questions which test you on those concepts which you generally tend to overlook or compromise on. Basically, you know very well that the recent ICAI's shift of focus is on those areas which are in the nooks and corners of a study material, those areas which we generally skip most of the times. So all those concepts, all those nooks and corners are covered in these questions. I had already shared the questions with you in the form of 4 test series. Remember, I had split these questions in the form of 4 test question papers. Along with the answer key, I've already shared it with you for both law and for DT. Now this is a discussion video where I wanted to discuss the answers with you, so that with me through the video you are able to get done with these LDR questions. These are new questions which you've never seen ever before because they've been freshly drafted, but they are those questions which you should be seeing the day before the exam. So with me, at least I'm hoping that you're able to get done with these a little more effectively, because I'll also try to give you a revision of the concepts involved in these questions through this video. Okay, so let's start off with law. This video is discussing this video is to discuss the LDR questions, the ForeQast test questions relating to law. All right, 4 tests we have in law. Let's start with the very first test. So on your screen, you will be seeing the question paper over here and the answer sheet over here. All right. So let's straight away start off with the first test, descriptive questions, and then we'll come to the MCQs a little later. Okay. So I'm in test 1. In the descriptive questions. Alright, come on, have a look at the first question over here. The question says XYZ Limited issued a prospectus on 31st May 24. Be careful, this is the date of issue of prospectus, inviting the public to subscribe for 10 lakh equity shares. But applications were received for only 4 lakh shares by 30th June 24. But the minimum subscription mentioned in the prospectus was 6 lakh shares. This itself tells us what the whole question is about, guys. Section 39, which deals with allotment, minimum subscription and all of that. So section 39 says that once a company issues a prospectus, within 30 days, the company is supposed to receive the minimum subscription as stated in the prospectus. In this question, the minimum subscription is 6 lakh shares, guys, but the company has received application for only 4 lakh shares. So clearly the minimum subscription has not been received by the company. In such cases, within 15 days after the closure of issue, the company is supposed to refund the money. If the money is not refunded within these 15 days, then the directors and the officers in default will be jointly and severally liable to repay the money along with the interest at 15% per annum. This is a provision, guys. So come on, let's continue reading the question. Company, however, neither proceeded with the allotment nor refunded the application. Company did not do the allotment, correct, but company did not refund the application money also. This is wrong. Clearly, it's a non-compliance. Analyzing the provisions of the Companies Act relating to the allotment of securities, state whether XYZ Limited has complied with the applicable provisions or not, question number 1, and also discuss a liability of the directors in the present case. So 2 things are asking us, whether the company has complied with the provisions or not, and also what is the liability of the directors and officers in default. Now see, be careful. Let's quickly discuss the answer now. The provision first, it's a case-based question. First, I will write the provisions, then I will apply the provisions in my question, and then I will write the conclusion. So first, we'll write about all the relevant provisions. Point number 1, the company should be receiving minimum subscription as stated in the prospectus. This should be received within 30 days from the issue of prospectus. If it is not received, then the company should refund the money within 15 days from the closure of the issue. If it is not so refunded, then who will be liable? Directors and officers in default will be liable. What kind of liability? Jointly and severally liable, guys. This is a key word. They will be jointly and severally liable to repay the money along with interest at 15% per annum. Right, guys? This is a provision. Now, in this question, first of all, minimum subscription was not received because minimum subscription stated in the prospectus was 6 lakh shares, but we received application for only 4 lakh shares. So minimum subscription was not received. So company should have refunded the money, guys. Company should have refunded the money within the next 15 days. By 15th July 24, the company should have refunded the money, but the company did not refund the money. So therefore, 2 things are asking us. Has XYZ Limited complied with the applicable provisions? No, XYZ Limited has not complied with the applicable provisions. Then they're asking us, what is the liability of the directors? Tell me who will be liable? Directors and officers in default. What kind of liability? Jointly and severally liable. They are liable to pay what? They're liable to repay the money along with interest. Interest at what rate? 15% per annum. Okay, so provisions, analysis or application, whatever you want to call it, and conclusion. In my conclusion, I will always come back to the question, see exactly what the question is asking me, and to the point, answer it and close. Okay, so this was your very first question. Now come on, let's have a look at the 10th question over here. The next question. The question says Novatech Private Limited, a startup company duly recognized by the Department for Industrial Policy and Promotion, issues an instrument called a convertible note to certain investors. Each investor subscribes 30 lakhs rupees in a single tranche, and the terms of the instrument state that the amount shall either be repaid upon the expiry of 8 years from the date of issue, or it will be converted into equity shares of the company upon the occurrence of specified events. So I have a private company, it's a startup, it is recognized as a startup by DIPP, it has issued a convertible note, each investor is subscribing 30 lakh rupees in a single tranche, and the money and the convertible note will either be converted into equity shares upon expiry of 8 years, or it will be repaid. Some shareholders of Novatech argue that the receipt of money is nothing but a deposit under Companies Act 2013, and therefore the company has violated deposit rules. Others argue that it is not a deposit at all. Define deposits, analyze the provisions of Companies Act 2013 and deposit rules, and state whether the issue of convertible note in this case would be regarded as a deposit or not. Two things they're asking us. Number one, define deposits. What is the definition of deposits? As per section 2 clause 31, deposit includes any receipt of money by way of deposit or loan or in any other form by a company, but does not include such categories of amount as may be prescribed in consultation with RBI. Come on, repeat the definition again. Deposit includes any receipt of money by way of deposit or loan or in any other form by a company, but does not include such categories of amount as may be prescribed in consultation with RBI. Be careful, in consultation with RBI, not SEBI. Okay, in consultation with RBI. Now, this was the first part of the question, guys. The second thing they're asking us is whether this convertible note will be regarded as a deposit or not. Come on, try to recall the provision about convertible note. Convertible note in deposits we have learned. So in the answer, first of all, we'll write what is a convertible note, guys. Now try to recall what did we learn in the deposits chapter. We had learned that money which the company is receiving against convertible note will not be considered as deposit. That is, it will be excluded from deposit provided some conditions are fulfilled. Condition number one, the company has to be a private company which is recognized as a startup by DIPP. Then the money which the company has received against convertible note should be at least 25 lakh rupees. The money should be received in one single tranche, and the convertible note should either be converted into equity shares or it should be repaid within 10 years. If all these conditions are fulfilled, then whatever money the company has received against convertible note will not be considered as deposit. This is what we had learned, guys. Now come on, let's check whether all these conditions are fulfilled over here or not. Tell me, is it a private company? Yes, it is a private company. Is it a startup company recognized as a startup by DIPP? Yes. The company has issued convertible note. How much money is the company receiving against convertible note? 30 lakh rupees, which is at least 25 lakh rupees. And this money should come in a single tranche. Yes, it has come in a single tranche. And this convertible note, either it should be converted into equity shares or it should be repaid within 10 years, maximum 10 years. Here it is being done. Here it is going to be converted within 8 years, which is within 10 years. All the conditions are fulfilled, guys. So therefore, this company, whatever money it has received against convertible note, it will not be considered as deposit. All the conditions are fulfilled. Hence, whatever money the company has received against this convertible note, not considered as deposit. Simple, guys, easy. Okay, now come on, have a look at the 11th question now. The question says, Star Built Limited, an unlisted public company, issued non-convertible debentures worth 100 crore rupees. In the current year, out of profits, company transferred 10 crore rupees into a special reserve account described as the Debenture Redemption Reserve. See, guys, we know very well that 10% of the outstanding debentures have to be transferred by the company every year till the debentures are outstanding from the profits to debenture redemption reserve. Correctly, the company has done. The debentures outstanding is 100 crores. 10% will be 10 crores. 10 crores out of profits company has transferred into DRR. And yes, debenture redemption reserve concept is not applicable to every company. All India financial institutions, banking companies, NBFCs, housing finance companies, listed companies, to them this concept is not applicable. But it is applicable to other unlisted companies. Hence, yes, there is proper compliance over here. Then comes the second part over here. To safeguard the interest of the debenture holders, company proposed to appoint Mr. Rohan, who is a CFO of the company, as debenture trustee. This is a simple point. You remember learning in our debentures discussion, we had learned that who cannot be appointed as debenture trustee, guys. In that, one of the points was if you are a KMP, key managerial personnel of cash of company or associate or subsidiary or holding company. So KMP of cash, they can't be appointed as debenture trustee, and CFO does come under KMP. So wrong. Mr. Rohan, you can't be appointed as debenture trustee. Alright. Then comes another para over here. The question says, within a year of the issue, company defaulted on the payment of interest to the debenture holders. Several debenture holders holding 22% of the total value of debentures submitted a written requisition to the trustee demanding that a meeting of the debenture holders be called to discuss the default. Mr. Rohan, that is the debenture trustee, ignored the requisition and did not convene the meeting. Is this allowed, guys? Is this okay? See, I'll remind you about the provision. In our debentures discussion, we had learned about the debenture trustee's responsibility to call the meeting of the debenture holders. The debenture trustee has to call a meeting of the debenture holders in two situations. Situation number one, if the debenture holders have submitted a written requisition, if debenture holders put together holding at least 1/10 of the value of debentures, if they have submitted a written requisition to the debenture trustee, then he will call a meeting of the debenture holders. Also, if any remember, any breach, event or default happens in the company which is going to affect the interest of the debenture holders, out of these two cases, if any of the two cases happens, then the debenture trustee should call a meeting of the debenture holders. In this question, both guys, in this question number one, yes, debenture trustee holding at least 1/10 of the debentures are submitting the written requisition. Also, there is a default in the company which is going to affect the interest of the debenture holders. So both the points are covered over here. Any one out of these 2 points are covered, the debenture trustee has to call a meeting of the debenture holders. So here again there is a non-compliance. The meeting of the debenture holders should have been called. Rohan has not called. Now the question is asking us 3 things. Number 1, comment on the validity of DRR. It is valid, guys. We just spoke about this. 10% of the outstanding debentures has to be transferred into DRR out of profits. Company has correctly transferred it. Then whether Mr. Rohan is eligible to be appointed as debenture trustee. We discussed that no, he can't be appointed as debenture trustee because KMP of cash can't be appointed as debenture trustee. Mr. Rohan is a CFO and CFO does come under KMP. So Rohan's appointment as debenture trustee is invalid. Then state the liability of the debenture trustee in relation to the meeting demanded by the debenture holders. He should have called the meeting of the debenture holders. What are the 2 situations in which debenture holders meeting is to be called? 2 situations, guys. Situation number 1, when the debenture holders put together who are holding at least 1/10 of the value of debentures, if they have made a written request to the debenture trustee, then he should immediately call a meeting of the debenture holders. Second situation, any BED happens in the company. B for breach, E for event or D for default. BED, breach, event, default. If any of these 3 happen which is going to affect the interest of the debenture holders, immediately the debenture trustee should call a meeting. So in this case, if you see, the debenture holders holding 22% of the debentures have made the written request. Also, the company is defaulting in the payment of interest over here. Hence, the meeting should have been called by the debenture trustee. He did not call. So even here, there is going to be a non-compliance. Okay, so this was our question focusing on debentures. Now come to the 12th question over here. This question is entirely about section 61, guys, alteration of capital. So the question says, for each of the following independent situations, state whether the action amounts to alteration of share capital under section 61 or reduction of share capital under section 66 or neither. Also state whether NCLT's approval is required or not. So 2 things they're asking us. Thing number 1, there are 5 situations, whether it is alteration of capital or whether it is reduction of capital or neither. And thing number 2, whether NCLT's approval is required or not. See, if it is alteration of share capital, NCLT approval is not required. When is NCLT approval required? Only if it is reduction of capital, section 66. There only we require NCLT approval. Okay, keep that in mind and come on, let's have a look at the 5 subdivisions one by one. The first subdivision says a company cancels shares that were never taken up by the public at the time of issue. cancelling shares which are not taken up by the public. This comes under section 61, guys, alteration of share capital. And because this is alteration of share capital, clearly NCLT approval will not be required. See, let me explain this to you, okay? About this point, let me give you some clarity. Listen to me carefully. See, I'll explain it to you over here. See, what does this provision, what is the situation even talk about? Let us say the company has an authorized capital of 1 lakh shares of 10 rupees each, okay? And out of this, let us say the company has issued to the public some 90,000 shares of 10 rupees each, all right? But the public was willing to take up only 88,000 shares of 10 rupees each. So can I say that 2,000 shares the public has not taken up? Right, guys? These 2,000 shares become those shares which the company was willing to offer to the public, but public has not taken up. So these 2,000 shares which have not been taken up by the public, the company can cancel. So what the company will do is, from the issued capital, the company will change this into 88,000 shares, and the authorized capital will also be reduced to, let's say, 98,000 shares. So in this situation, what the company has actually done is, the company has cancelled the shares which are not taken up by the public. 2,000 shares were not taken up by the public. Company has reduced that from the authorized capital also, from the issued capital also. This is called as cancelling shares which are not taken up by the public. See, over here, because the authorized capital is getting altered, it is definitely going to be section 61. Issued capital is also getting altered. So ideally this should also involve section 66, but this is an exception. Section 66, reduction of capital, will not apply over here. Instead, this is section 61 only, alteration of capital. In alteration of capital, 5 points we have. Number 1, increasing or decreasing the authorized capital. Number 2, converting fully paid shares into stock or vice versa. Number 3, subdivision of shares. Number 4, consolidation of shares. The 5th point is this only, cancelling shares which are not taken up by the public. This is also called as diminution of share capital. This cancellation of shares not taken up by the public, it is going to be section 61 only, alteration of share capital only, and not section 66. And hence NCLT approval will not be required. Then comes a second subdivision over here. 1 minute. Here. The second one says a company increases its authorized share capital from 10 crore to 15 crore. Increasing or decreasing the authorized capital, guys, this will come under section 61, alteration of capital. And because it is section 61, because it is alteration of capital, NCLT approval also is not going to be required, right, guys? Then comes the third subdivision. A company reduces the liability of members in respect of unpaid share capital, thereby treating partly paid shares as fully paid. Company is reducing the liability of members. Come on, try to recall. Reducing or extinguishing the liability of members. This comes under section 66, guys. This comes under reduction of capital, and because this is going to be reduction of capital, section 66 will apply, and under section 66, yes, NCLT approval is required. Let me try to help you understand this in case you haven't followed what the situation is. Company is reducing the liability of members. Like, for example, let us say that the company has issued shares 10 rupees face value, okay, and the shares only 8 rupees is paid up. This is the paid up value per share. So what is the liability of the shareholders? They still have to pay 2 rupees more to the company, guys, but company is telling the shareholders, no, you don't have to pay that 2 rupees. So the shareholders right now, they have a liability to pay 2 rupees to the company per share, but the company is telling the shareholders, you don't have to pay this 2 rupees. So the company is reducing the liability of shareholders. The company is extinguishing the liability of shareholders. This comes under section 66, guys. We're telling the shareholders, you don't have to pay this 2 rupees. We will treat as if 8 rupees face value, as if 8 rupees fully paid up. You don't have to pay the balance 2 rupees. This comes under reduction of share capital, section 66. And because section 66 will apply over here, NCLT approval will be required. Okay. Then comes a fourth subdivision. Company is converting its fully paid equity shares into stock. Conversion of fully paid equity shares into stock. This is also going to come under section 61, alteration of share capital. And because it is section 61, alteration of share capital, NCLT approval is not required. Any situation, guys, section 61, if section 61 only is applicable, if 66 is not applicable, then NCLT approval is not required. NCLT approval, tribunal approval approval will be required only if section 66 reduction of capital is applicable. Okay, then comes the last point. A company buys back its own shares in accordance with section 68. If the company is buying back the shares, neither section 61 will apply nor section 66 will apply. Neither is it alteration of capital nor is it reduction of capital. It is buyback. Buyback is an independent concept altogether. If the buyback is as per section 68, NCLT approval also is not required. Right guys? So it is neither alteration of capital nor reduction of capital, and if it is buyback as per section 68, then NCLT approval also is not required. Okay. So 5 subdivisions. Come on, let me give you one quick revision. Cancelling shares which are not taken up by the public. Section 61, alteration of capital. Increasing or decreasing the authorized capital is again section 61, alteration of capital. Then reducing the liability of members with respect to capital not paid, extremely important guys. This is going to be reduction of capital. Then converting fully paid equity shares into stock. Please remember that company cannot convert partly paid equity shares into stock. Only fully paid only can be converted into stock, and this is going to be alteration of capital, section 61. And finally, buying back shares will be section 68. Neither section 61 nor section 66. It's a separate concept altogether, section 68. Okay, then comes your next question, your 13th question. Let's read the question carefully first. This is about your differential voting rights. Okay, a very interesting question, a computation question this is. So the question says, Globe Tech Limited, a public company, has issued the following share capital. It has 6 lakh normal equity shares where one share has one vote. Okay, 4 lakh equity shares with differential voting rights where each share carries 1.75 voting rights. First of all, is it okay guys? See, understand that a lot of times students have this misconception. Students think that differential shares means the voting right will be lesser. It is not necessary. It can be more also. Differential shares, just that the voting right will be different. It can be less also, it can be more also, it can be either. Here the voting right is higher. Generally, one share is having one vote, but these DVR shares, they are having one share is having 1.75 votes, which is perfectly fine. Then the question says, some investors argue that with this structure, DVR shareholders may end up exercising disproportionate control in the company. Subsequently, company proposes a bonus issue. At this stage, the DVR shareholders demand that their bonus shares should be issued as normal equity shares so that they may enjoy equal rights in the future rather than being locked into shares carrying differential rights. So there are two things in this question guys. Thing number one, the company has issued equity shares with differential rights where one share is having 1.75 vote. The second thing is that the company is making a bonus issue, and the DVR shareholders are saying that when you make a bonus issue, give us bonus shares which are having one share, one vote only. Don't give us DVR shares, give us normal equity shares only when you give us bonus shares. This is wrong guys. The law very clearly says that whenever the company makes a bonus issue, the bonus shares will be of the same class as the original shares. So the original shares are DVR shares, so even the bonus shares will also be DVR shares only, right guys? Then they're asking us two things: whether the voting power of DVR shareholders on the basis of the above numbers falls within the permissible limit prescribed for equity shares with differential rights. Support your answer with calculation whether the voting power of the DVR shareholders is within the legal limit. What is the legal limit guys? What is the maximum voting power that your DVR shareholders can enjoy? Put together they can enjoy maximum 74% of the total voting power. So we have to check whether it is within the limit or not. Come on, let's have a look. Company is having two types of equity shares. One is normal equity shares, 6 lakh normal equity shares guys, where one share is having one vote. So the normal equity shares are having total 6 lakh votes. Then we are having equity shares with differential rights, total 4 lakh such shares we are having, where each share is having 1.75 vote. So these 4 lakh shares are going to totally have 7 lakh votes. 4 lakh into 1.75. So total voting power in the company is how much? 6 lakhs plus 7 lakhs. Total voting power in the company is 13 lakh votes. So out of these 13 lakh votes, the equity shares with differential rights are holding 7 lakh votes only guys. So 7 lakh votes divided by 13 lakhs into 100. This should be 100, okay? So the equity shares with differential rights are totally having how much percentage voting right? They're having 53.85% voting right, which is within 74%. Hence, the first question is answered. The first question was whether the voting power on the basis of the above numbers is within the permissible limit or not. Show calculation. Yes, it is within the permissible limit. They're having voting power of 53.85% only, which is within 74%. Hence, it is within the permissible limit. Then one more thing the question is asking us, whether the demand of DVR shareholders that their bonus shares should be normal equity shares instead of DVR. Is that sustainable? No, sorry. That is not sustainable. The bonus shares will be of the same class as the original shares. If the original shares are shares with differential rights, the bonus shares also will carry the same differential rights only. So, the claim or the demand of the DVR shareholders that their bonus shares should be normal equity shares, that is not legally sustainable. Understanding, everybody? If the original shares are DVR shares, even the bonus shares also have to be DVR shares only. Alright, so this was question number 13. I think the first part was very interesting, the computation part. Now come to question number 14. The question says Neo Home Appliances Limited, a public company, has been raising money through deposits. On 1st June 24, it accepted fixed deposits of 50 lakhs from its members. Can a public company accept deposits from members? Yes. A public company, private company, any company can accept from members. Restriction only is only on accepting deposits from the public. Only eligible public companies only can accept from the public. But from members, private companies, public companies, both can accept. The deposits were structured in such a way that company promised to repay them after 4 months. So guys, the deposits are having a tenure of 4 months, which means less than 6 months, which means these are deposits for short term period, right? Generally, the deposits tenure is 6 months to 36 months maximum. But if it is less than 6 months, yes, the company can accept deposits for a short term period, that is for 3 months to 6 months. These short term deposits maximum will be how much allowed? Maximum 10% of the paid up share capital plus free reserves plus securities premium, guys. So point number 1, the company is accepting deposit from the members. Point number 2, because the tenure is 4 months only, clearly these are short-term deposits. So if short-term company, be careful about the limit. The limit will be maximum 10% of paid up share capital plus free reserves plus securities premium. Company did not issue any deposit receipt until 30th June 24. What is the provision regarding deposit receipt? Do you know this? See, I'll tell you, I'll show you the timeline, okay? I'll draw it for you over here. Listen to me. The provision goes like this. Once a company receives the deposit money, okay, from the date of receipt of the deposit money, within 21 days, the company has to issue a deposit receipt to the depositor. In the deposit receipt, 5 things a company will write. The hint to remember the 5 things is drama, where D stands for date of deposit, R stands for the rate of interest, A stands for the amount of deposit, M stands for the maturity date of the deposit, and A stands for the address and the name of the depositor. So once again, the provision goes like this. Once a company receives the deposit money, within 21 days itself, the company is supposed to give a deposit receipt to the depositor. In the deposit receipt, the company is supposed to mention these 5 things. But however, in the question says that when did the company accept the deposits, guys? Company received the deposit money on 1st June 24. So 1st June 24 plus 21 days, company should give the deposit receipt. That is, by 22nd June 24, company should give the deposit receipt. But till 30th June also, the company has not issued the deposit receipt, so there is a default over here. Advise whether the company has complied with the provisions of Companies Act relating to deposits. So in this question, there are totally 2 things which are being tested. One is about the tenure of deposit and the other thing is about the deposit receipt, right guys? So tenure of deposit, generally it has to be anywhere between 6 months and 36 months. But however, if the company is accepting deposits for short-term requirements, then it can be less than 6 months also, but it should not be less than 3 months. Basically, for short-term requirements can be from 3 months to 6 months. And for short-term requirement, maximum how much the company can accept, guys? 10%. 10% of paid up share capital plus free reserves plus securities premium. So this is the provision about the tenure of deposits. In this question, the tenure is 4 months, which means it is less than 6 months. But okay, fine. it is not less than 3 months, which means it is between 3 months and 6 months. So it is perfectly accepted for short-term requirement. But they haven't told us what is a paid up share capital, free reserves and securities premium. They haven't given us that information. So we can't check whether it is within the 10% limit or not. So we'll assume it is within the 10% limit and we'll say that the deposits are accepted for short-term requirement and it is as per the applicable provisions. Okay. Then the second point in the question is about the deposit receipt. Deposit receipt company has clearly done a violation, guys, because from the date of receipt of the money, within 21 days, company is supposed to issue the deposit receipt. Company received the money on 1st June 24. Plus 21 days will be 22nd June 24. So by that date, the company should have given the deposit receipt. But here if you see, it is 30th June 24 and still the company has not given deposit receipt. So yes, here there is a non-compliance. So the company has complied with the provision of tenure of deposits. Company has complied. It is short-term deposit, but it has not complied with the provision of deposit receipt. Okay, within 21 days of the receipt of money, the company should have given the deposit receipt. All right, I'm just giving you one more reminder over here that see the time, there's a timeline in deposits. Okay, once a company receives the money, from the date of receipt of the deposit money, within 21 days the company is supposed to issue the deposit receipt to the depositor, guys, containing these 5 things. Then once a company issues a deposit receipt, no, from that date, within 7 days the company has to make an entry in the deposit register also. So the 7 days point not relevant in this question, but just letting you know because it's an interconnected point that once a company issues the deposit receipt, from that date within 7 days company has to make an entry in the deposit register also. Okay, so this was your question number 14. Now come to question number 15. The question says Everglow Limited, a public company, the board of directors wanted to make some special clauses in the AOA of the company which is impossible to amend or difficult to amend. Board wants to know whether this is permissible under law. As a student of corporate law, advise the board on the same. Tell me, guys, is it possible to insert some special clauses in the AOA which are impossible to amend or which are difficult to amend? Which concept are they talking about? Come on, tell me. Difficult to amend the AOA. Which concept? Entrenchment provision, guys. So yes, entrenchment provision can be inserted, and with entrenchment provision we can make it difficult to amend the AOA. But can we make it impossible to amend the AOA? No. Can we make it difficult to amend the AOA? Yes. Right, guys? So this question is about entrenchment provision. So entrenchment provisions are those provisions in the AOA because of which you can still alter the AOA, just that it makes it more difficult. Generally, to alter the AOA, what do you require? You only require a special resolution, guys, generally. But however, through an entrenchment provision, we can require something more restrictive, or we can require something stricter than special resolution, something more restrictive than special resolution. See, special resolution is what? 75% of the votes should be in favor, right? Through the entrenchment provision, we can say that to alter one particular clause in the AOA, more than 75% votes are required. Like for example, we can say that 90% of the votes in favor are required, only then we can alter this particular clause of the AOA. So yes, through an entrenchment provision, we can make it difficult to amend the AOA. Generally, 75% votes in favor is enough to alter any clause of AOA. But if there is an entrenchment provision, it can provide a number which is even more stricter or even more restrictive than special resolution. Okay, now how will this now 2 questions arise. Question number 1, when will the entrenchment provision be inserted in the AOA, and number 2, how to insert it into the AOA. See, what's the timing, when should it be inserted into the AOA? 2 options we have. Either it can be inserted in the AOA at the time of incorporation of the company itself, or it can be inserted later. Now if you're inserting it later, then in that case, if it's a private company, we will require the consent of all the members. That is, we will require a unanimous resolution. But if it is a public company, it can be inserted by passing a special resolution. Okay, so both the things I've discussed with you. Number 1, when should you insert the entrenchment provision? either at the time of incorporation or later. Then how should you insert the entrenchment provision? If it's a private company, you need a unanimous resolution, that is all the members should be in the favor of the entrenchment provision. If it's a public company, SR, special resolution is required. That is how we insert an entrenchment provision. Okay, and once the entrenchment provision is inserted in the AOA, within 30 days itself we have to inform the ROC about it. That's all, guys. So this is your entire entrenchment provision concept. So this question was slightly trying to confuse you. Is it possible to make it impossible to amend the AOA? No, you can't make it impossible to amend the AOA. You can only make it difficult. You can only make it stricter. How do you make it difficult? By inserting an entrenchment provision. What is an entrenchment provision? Generally, only a special resolution is required to alter the AOA, but through the entrenchment provision, we can require something more stricter. We can require something more restrictive than special resolution to alter the AOA. That is called as entrenchment provision. So through entrenchment provisions, yes, we can make it difficult to amend the AOA possible. Okay. Then comes your last question over here. The question says, Zenith Motors Limited, a public company, made a public offer of equity shares through a prospectus in Jan 24. In the prospectus, company clearly mentioned that the shares would be listed on the National Stock Exchange. After the issue closed and the allotment was made, several investors discovered that company had not taken any steps to apply to NSE for permission to list the securities. Section 40, guys. Section 40 very clearly says if the company is making a public offer, before the company can make the public offer, before it can issue the prospectus itself, it should make an application in one or more recognized stock exchanges, application to get listing permission basically. And the company must also mention in the prospectus the name of the stock exchanges where such application has been made. The company can go ahead and allot the securities only if the permission is received from all the stock exchanges wherever the company had made the application. Now in this question, this is company Zenith Motors Limited. It is making a public offer, guys. In the prospectus, it is stating that we have made application, the securities will be listed in NSE. But actually the company has not even applied in NSE for listing permission. Instead, Zenith Motors argued that since investors had already subscribed and received allotment, it was not necessary to approach the exchange and the company could continue with business as usual. No, company, you're terribly wrong over here. Section 40 very clearly says that you should get listing permission from all the stock exchanges wherever you have made the listing application. Only then you can do the allotment. Only then you can utilize the money. Here, you have mentioned in the prospectus that you will be listing the securities in NSE, but in reality you did not even make application to NSE to list the securities. You have not received any listing permission from NSE, so you can't use the money, you can't allot the securities. This allotment is going to be an irregular allotment, guys. Then the question says, some investors complained to SEBI claiming that their shares had become untradeable in the absence of listing and the company had violated the law. Company's directors defended themselves, stating that Companies Act does not specifically compel them to list the shares once they have raised capital successfully. Examine the provisions of Companies Act in relation to securities offered to the public and their requirement to be dealt with in a stock exchange. Is the contention of the directors of the company valid in law? No. Section 40, guys, an extremely important section. Listen to me. The section says every company making a public offer must, before making the offer, make an application to one or more recognized stock exchanges and obtain permission for the securities to be dealt with in such stock exchanges. So two things, you must make an application and you must get listing permission. Even in the prospectus, you must state the name of the stock exchange where the application has been made. Company should allot the securities only when the securities are permitted to be dealt with in such stock exchanges. Now, in this case, Zenith Motors Limited made a public offer through a prospectus wherein it was stated that it has made an application to NSE for permission, but the company did not even make the application. Default number 1. Default number 2, even without obtaining permission, the company has allotted the shares, guys. This is going to be irregular allotment. So there are two problems over here. Problem number 1, the company did not even make the application to NSE. Problem number 2, even without getting listing permission, they have allotted shares. So there are two violations over here. There are two non-compliances over here. So therefore, the contention of the directors is totally not valid. The company is saying, the directors are saying that once we have allotted the shares, we are free to use. No, it's terribly wrong. The company is saying it was not necessary to approach the exchange. Company could continue with business as usual. No, company, there's a process which you have to follow. First, you have to make listing application in all the stock exchanges wherever you want the securities to be dealt with. Then you have to get listing permission from all the stock exchanges wherever you submitted the listing application. Only then you can go ahead and allot the securities and use the money. If you don't get listing permission, you can't make the allotment. Here the company forget about getting listing permission. They did not even make the application in the stock exchange. So therefore there is clearly a violation. Alright guys, so these were your descriptive questions of the first test. Now come on, let's have a look at the case study based MCQs as well. I have three case studies, three case studies in this question. Let's see them one by one. Look at this. I have zoomed it a little bit. It will be easier for you to read now. Look at the questions. We have three stories. Let's have a look at the first story. The question says Mr. Arjun, an Indian citizen aged 32 years, he incorporated Arjun Innovations OPC Private Limited with his close friend Mr. Ravi as nominee. Can even a friend be appointed as a nominee? Yes, not a problem. Interestingly, Arjun was already serving as a nominee in another OPC. At the same time, can Mr. Arjun be a member in one OPC and can he also be a nominee in some other OPC? Yes guys, it is allowed. See, a person cannot be a member in two OPCs at the same time. At the same time, a person cannot be a nominee in two OPCs. But a person can be a member in one OPC and a nominee in another OPC at the same time. It is allowed. That is what has happened over here. He is a member over here in one OPC and he is a nominee in another OPC, Bright OPC Private Limited. Perfectly allowed. Then the question says, he felt confident he could handle both the rules. Yes, it is allowed. Within a year, Arjun Innovations attracted attention from a reputed charitable trust which believed that Arjun's company could be a perfect vehicle for promoting social welfare through innovative educational projects. The trust offered substantial funding but added one non-negotiable condition: Arjun's OPC must be converted into a Section 8 company. Is this allowed? See, a one-person company can be converted into a public company. It can be converted into a private company, but it is prohibited. It cannot be converted into a Section 8 company. This is not allowed. At the same time, Arjun decided to change his nominee. He wished to appoint Miss Meera, an old college friend. Can he change the nominee? Yes. Whether the nominee withdraws his consent or not, the member of the OPC, if he wants, he can change the nominee. And remember, if the only change is change of nominee, it will not be considered as change of MOA also. Then Meera was already serving as a member of one OPC and a nominee in another OPC. Guys, Meera is already a member in one OPC. She is already a nominee in another OPC. Can she also be appointed as a nominee in Arjun's OPC? This will not be allowed because she can be a nominee only in one OPC. She is already a nominee in another OPC. She cannot also be appointed in Arjun's OPC as a nominee. So, because if that happens, she will become a nominee in two OPCs. That is not allowed. Arjun saw this as a technicality and assumed it wouldn't create trouble, but the situation was clearly not as simple as he thought. Caught between the trust's demand, the nominee's restrictions, and the web of legal limitations around OPCs, Arjun now found himself in a delicate position where every choice carried legal consequences. The first question: can Arjun validly incorporate Arjun Innovations OPC Private Limited when he is already a nominee in Bright OPC Private Limited? Yes. At the same time, he can be a nominee somewhere else and he can be a member in another OPC. It is allowed. So yes, yes, yes. So it can't be option B. Yes, there is no restriction. Sounds right. Yes, but only if Arjun is resident in India for 180 days. No, it is not necessary, guys. Only thing is, member and nominee, they should be Indian citizen and they should be a major. Whether they are a resident in India or not, it is not mandatory anymore. And yes, provided he exits from Bright OPC within 180 days. No. So our answer is option A. Then comes your next question over here. Can Arjun convert Arjun Innovations OPC Private Limited into a Section 8 company? No guys, it can be converted into a public company, it can be converted into a private company, but a one-person company can never be converted into Section 8 company. So the answer is no, option B. Then don't even have to read the whole thing, it can't be yes, so it is straight away option B. Then comes question number 3. If Arjun wants to appoint Miss Meera as his new nominee, can she be validly appointed? Meera's appointment as a nominee was incorrect, guys, because she's already a nominee in one another OPC. At a time, a person can be a nominee only in one OPC. So she's already a nominee somewhere else. She can't be a nominee in Arjun's OPC. So is her appointment valid? No, it is not valid. So it can't be yes, it can't be A or C, either B or D. B says no, because a person cannot simultaneously be member of one OPC and nominee in another. This reason is not right. You can be member in one OPC and nominee in another OPC. That is allowed. So no, because person cannot be member in more than one OPC or cannot be nominee in more than one OPC at the same time. It is option D. Right, guys? So this was about your one person company. Then come to the second case study. The question says, Blue Sky Technologies Limited, a public company, is engaged in developing AI-based logistics software. It has recently been in the news for its ambitious expansion. At its last AGM, one shareholder, Mr. Karan, demanded a copy of the MOA and AOA along with certain other filed documents. Company secretary told him verbally that the documents are available on the MCA website and refused to provide a physical copy. When Karan persisted, company said he could get them only if he pays admin charges of 5,000 rupees. Terrible. See, I'll remind you about the provision, okay? We have section 17 in our Companies Act. Section 17 says that whenever any member of the company demands the MOA copy or AOA copy, within 7 days, the company is supposed to provide it to him. Yes, the company can charge a fee for this, but they can't randomly charge whatever they want. They can't randomly charge 5,000 for it. Then, and by the way, one more thing, okay? See, I'll draw one small table for you here. See, the provision is like this. Let's say members of the company, they want the MOA or they want the AOA copy, okay? They can, under section 17, they can ask the company for the MOA AOA copy, or they can also go to the MCA website, guys, and they can download it from there itself. But if it is an outsider, if you're not a member of the company and if you want the MOA or the AOA copy, for you can't come to section 17. Outsider can straight away get from the MCA website only. So the members have two options. Either the members can ask for the MOA AOA copy from the company itself under section 17, in which case company should provide it to them within 7 days itself, of course for a fee, or the members can download it straight away from the MCA website because they are public documents. But if you're an outsider, even you can access the company's MOA or AOA, but from the MCA, from the MCA website you can download, but you can't come under section 17 and demand the company. No, section 17 is only for the members of the company and not for outsiders. Okay. So coming back, in this question, if you see, Karan is a shareholder and he is demanding the company for a copy of the MOA or AOA, which means he is not going to the MCA website. Under section 17, he is demanding from the company. Yes, he can demand. Company should give it to him within 7 days. Then the question says, meanwhile, the company's articles contain a clause that says, Mr. Raj shall always act as a legal advisor of the company and he shall be paid 5 lakh annually for his services. Initially, Raj proudly introduced himself everywhere as a permanent legal brain of Blue Sky Technologies Limited. However, when the board later refused to honor this clause, saying Raj's services were no longer required, Raj was furious. He stormed into the company's office, slammed a copy of the AOA on the boardroom table, and declared that the company was bound by its own AOA and could never remove him. He even threatened to sue the company. Understood, guys? The question says, in the company's AOA, it is mentioned that Mr. Raj will always be the legal advisor of the company. But then, however, later the company removed him. Later, the board refused to honor this clause, saying Raj's service were no longer required. So later they removed him. Now Raj is furious. Raj is asking the company, follow your AOA. Tell me, guys, can the AOA bind the company to the outsiders? No. The AOA only talks about the relationship between company and the members. So the AOA binds the members to the company and company to the members. But can the AOA bind the company to the outsiders? No. If the outsider wants to enter into any contract with the company, if the outsider wants to enforce his rights, he has to enter into a contract with the company. He cannot force, like for example, over here, Mr. Raj is an outsider, right? He's a legal advisor of the company. He's an outsider. Now he cannot force the company to follow the AOA. The company is not bound to the outsiders because of the AOA. So that is the whole reason why we have contracts. So ideally, Mr. Raj and the company should have entered into a contract. On the basis of the contract, Raj could have forced the company to follow the contract. But Raj cannot force the company to follow the AOA. The AOA cannot bind the company to the outsiders. So what Raj is doing over here is not right. The company can remove him. The company is not bound to follow the AOA when it comes to outsiders. Alright. Then the question says, to raise funds, the company issued a glossy prospectus full of glowing statements about its record breaking profits and brightest future in the industry. The prospectus was marketed with catchy taglines and investor roadshows where directors proudly claimed the company was on its way to unicorn status. Excited by these claims, hundreds of small investors rushed to subscribe, many even selling their old shares and savings to invest. But behind the curtain, the so-called profits were nothing more than exaggerated numbers and creative accounting tricks. When the truth slowly surfaced, investors felt deceived and outraged, alleging they had been lured into a trap. So clearly there is a misstatement in the prospectus. Not stopping there, company later issued shares at a hefty premium of 50 rupees per share. Yes, company can issue shares at a premium. Prohibition is only on issuing shares at a discount. At first, investors thought that the premium meant prestige and strength, but soon the board casually resolved to use this premium for paying fat dividends and lining the pocket of directors with extra remuneration. No, here there is a violation. Company cannot use the premium money for whatever it wants. It cannot use the premium money to pay dividends. It cannot use the premium money to pay remuneration to the directors. Section 52, guys, the premium can be used by the company only for selected purposes. Boldly declaring in the meeting, after all, premium is just another kind of profit. Why not enjoy it? No, this is wrong. This raised eyebrows everywhere, with shareholders whispering whether such an audacious move was even legal. Now, come on, let's have a look at the questions. When Mr. Karan demanded copies of MOA and AOA, company's refusal and demand of 5,000, is it valid, guys? It is invalid. Company first refused. That refusal is invalid. If the MOA or AOA is demanded by the member from the company, under section 17, company is supposed to give it within 7 days. And the demand of 5,000 rupees fees is also not valid. They can charge a fee, but it can't be this unreasonable. So is it valid? No, it is invalid. So clearly it is not option A, not option C. Option B says invalid since section 17 requires copies to be given within 7 days on request of on payment of prescribed fees only. Option B. Option D says invalid because no fees at all can be charged. No, we can charge a fee, but it can't be exorbitant fees. That's all. Then comes question number 5. The clause in the AOA requiring Mr. Raj to be appointed as legal advisor is it binding on the company, guys? No, AOA will bind the company to members. AOA cannot create a contract between company and outsiders. Outsider cannot bind the company to follow the AOA. So will the company be bound by the AOA requiring Mr. Raj to be appointed as legal advisor? No, it will not be binding on the company. So option B or option D. Since articles do not create contractual rights for outsiders, yes guys, there's no contract between company and outsiders through AOA. Option B. Not binding unless it is also included in MOA. No, option B. The AOA does not create a contract between the company and the outsiders. Then comes question number 6. Criminal liability for the untrue statement in the prospectus will fall on whom? There's a misstatement in the prospectus. So criminal liability, section 34, criminal liability is on whom? On every person who authorized the issue of prospectus. So every person who authorized the issue of prospectus, option C. Criminal liability, guys, under section 34, every person who authorized the issue of prospectus, he will be punished under section 447, remember? They're clearly asking you about criminal liability. Who is liable under section 34? Every person who authorized the issue of prospectus. Then comes question number 7. Company's use of share premium, was it valid? It was invalid, guys. So option B, option A is valid. C and D. It can't be valid. So it has to be option B only, invalid. Section 52 says that the securities premium money can be used only for certain specific purposes, like to issue bonus shares, buyback of shares, paying premium on the redemption of preference shares or debentures, then for writing off share issue expenses and preliminary expenses and all. But it can't be used to pay remuneration to the directors. It can't be used to pay dividend to the shareholders. So what the company was trying to do over here with the share premium money was clearly invalid. Right, guys? Then come to the third case study. The question says Bright Homes Limited, a public company, has recently been exploring new ways to raise funds for its ambitious smart city housing project. Company's latest audited balance sheet shows net worth 85 crores, turnover 520 crores. At a board meeting, directors debated whether the company qualifies as an eligible company to accept deposits from the public. Some directors argued that since net worth is less than 100 crores, company cannot raise deposits. Investors, meanwhile, were getting impatient, waiting for a deposit scheme to be launched. The board must now decide whether they are legally allowed to go ahead. So basically, they're asking us whether it is an eligible company or not. Can Bright Homes Limited accept deposits from the public? See, which company can accept deposits from the public? Only an eligible company only can accept deposits from the public. So here we have to check whether it is an eligible company or not. See, eligible company means a public company, guys. A public company whose net worth should be at least 100 crores or turnover should be at least 500 crores. Any one condition has to be fulfilled. Here if you see, yes, no doubt, net worth is not at least 100 crores, it is less than 100 crores. But the turnover is 520 crores, which is at least 500 crores. So yes, it does become an eligible company, guys. It is an eligible company. It can accept deposits from the public. Alright, so that is it. This was your first test. This test covered your basics, incorporation, MOA, AOA, prospectus, share capital and deposits. Alright, now we'll right away start off with our second test discussion as well. So starting off with the second test now. Even over here, we'll see the MCQs towards the end. Let's come to the descriptive questions. Come to question number 9. Let's read the question. The question says Brightwave Limited, a listed company with registered office in Mumbai, planned to hold its AGM in Pune, where its main factory is located. Some directors argued this was valid as Pune is still in Maharashtra. Meanwhile, Starlight Private Limited, an unlisted public company with registered office in Jaipur, wanted to hold its AGM in Delhi for the convenience of its investors. The board proposed to seek written approval of all its members before finalizing. And the third situation, the last situation, Solar Government Limited, a government company with its registered office in Chennai, proposed to hold AGM in New Delhi, citing convenience of senior government officials. Examine each of the above cases whether the proposed venue for holding the AGM is legally valid or not. Basically, this question is entirely about the place of holding the AGM. Come on, let's discuss. See, in our first situation, the company is a listed company, guys. For a listed company, the provision is like this. A listed company can hold its AGM either at the registered office itself or in any other place, but in the same city, town or village where the RO is situated. Now, in this question, the RO is situated in Mumbai. So, either the company should hold the AGM in this registered office in Mumbai itself or in some other place, but in the same city where the RO is situated. Here, they are trying to hold the AGM in Pune, which will not be right. Either they have to hold the AGM in the RO in Mumbai, or they can hold the AGM in any other place but in Mumbai only. They can't hold the AGM in Pune. This will not be valid, will not be legally valid. Okay. Then come the second situation. Here it's an unlisted company. For an unlisted company, the provision is unlisted company's AGM can be held either in the RO itself or in any other place but in the same city where the RO is situated, or in any other place but in India. But for that, we need the prior consent of all the members in writing or electronically. So here the company is an unlisted public company. The registered office is in Jaipur. So either the company can hold the AGM in the RO in Jaipur itself or in any other place but in Jaipur, or in any other place but in India, like for example in Delhi, provided we get the consent of all its members. So yes, it's an unlisted company. It can hold the AGM in Delhi provided it gets the consent of all the members. Okay, this is your second point. Then what about a government company? For government company, it's different, guys. In a government company also, the AGM can be held in the RO, or it can be held in any other place but in the same city where the RO is situated, or it can be held in any other place, but for that any other place it must be approved by central government. So here in the third situation, this company has registered office in Chennai. So either it should hold the AGM in the RO in Chennai, or in any other place but in Chennai, or anywhere else, but for that CG approval is required. Company wants to hold the AGM in New Delhi, not in Chennai, in New Delhi. So for that they require CG approval. So if they're able to get CG approval, only then it will be valid. Understanding? So what is a learning, guys? If it's a listed company, the AGM can be held at the RO or in any other place, but in the same city, town, village where the RO is situated. If it's an unlisted company, then in the RO or in any other place, but the same city, town, village where the RO is situated, or anywhere else in India, but for that we need the prior consent of all the members. I am not saying prior consent of majority of members, no. I am saying prior consent of all the members. All the members in writing or electronically, but we need prior consent of all the members. Okay, then comes the third point, government company. Government company's AGM will be held in the registered office or in any other place, but in the same city, town or village where the RO is situated, or anywhere else also, but for that we require central government approval. Okay, so understanding, if you are an unlisted company and if you want to hold the AGM anywhere else in India, you need the prior consent of all the members. But if you're a government company and if you want to hold the AGM in any other place in India, you require the central government approval. You don't require the approval of members, you require the central government approval. Only then you can hold the AGM in any other place in India. Okay, this was your first question about the place of holding the AGM. Then comes the next question. Bright Steel Limited, it's a public company. It appointed K&T Associates as statutory auditor. During audit, two different fraud situations arose. While verifying supplier payments, the auditors themselves detected a fraud where fake purchase invoices had been created by an employee to siphon off funds of nearly 1.50 crores. During the same audit, the management informed the auditors about another case of misappropriation of petty cash by a junior employee, which had already been internally investigated. So guys, it's a public company. In this public company, K&T Associates is a statutory auditor. During the audit, two frauds they found. In the first fraud, they found fake purchase invoices for up to 1.50 crores. In the same audit, they found one more fraud, the fraud of misappropriation of petty cash. But the second fraud over here, the auditor did not find. The second fraud over here, management informed the auditors. So the second fraud was not a fraud which was identified by the auditors in the course of audit. No, it is the management who has informed the auditors about the second fraud. Audit team is confused. One partner believes that, one partner believes that both cases must be reported to the central government. Another argues that matter need not be escalated to the central government. Section 143(12), guys, this very clearly says that in the course of audit, if the auditor finds a fraud in the course of audit and if the value is more than 1 crore, then the fraud has to be reported to the central government. But for that fraud, the auditor must find the fraud in the course of audit. In the second one, auditor has not found the fraud. The management has reported about the fraud to the auditor. So the second one need not be reported to the central government, but the first one has to be reported to the central government because this one was found by the auditor in the course of audit, and also the value is at least 1 crore. So if the value of the fraud is at least 1 crore, then it has to be reported to the central government. But only those frauds which he is finding in the course of audit, if the management has informed him about any fraud, that need not be reported to the central government. Then the question says that the board, worried about reputational loss, suggested that mentioning these matters only in the audit report would be sufficient compliance. They even went so far as to warn the auditors that if they reported the fraud to the central government, company would sue them for breaching their duty of confidentiality. Advised the auditors in the light of the relevant provisions of Companies Act 2013. An amazing question, guys, testing your knowledge on section 143 subsection 12. All the hidden points, all the nooks and corners of this section are being tested over here. Listen to me. See, what are the points involved over here? Point number one, there are two frauds. One fraud which the auditor found in the course of the audit, and another fraud which the management has informed the auditor. This is the first point. Second point over here is, should it be reported to the central government or should it not be reported to the central government? The third point is, board of directors is warning the auditors that only report about the fraud in the audit report and close the matter. If you report to anybody else, I will sue you for breaching the duty of confidentiality. Three things, guys, involved in this question. Come on, let's have a look at them one by one. First of all, the first question, that there are two frauds, one found by the auditor, one found by the management. Should it be reported to the central government or not? I've already told you this. If the fraud is found by the auditor in the course of audit, and if the value is at least 1 crore rupees, then yes, it has to be reported to the central government. So because of this point, the second fraud need not be reported to the central government because it was not found by the auditor in the course of audit. It was a management who informed the auditor about it. So this need not be informed to the central government. But the first one, the value is at least 1 crore and also it was found by the auditor in the course of audit. So the first one has to be reported to the central government. And how should it be reported to the central government? You must be aware of the process. I'll just give you a quick revision. The process I've mentioned over here. First of all, the auditor will prepare a fraud report. In that fraud report, he will put details like what kind of fraud it is, then what is the quantum, what is the amount involved in the fraud, who are the parties involved in the fraud, all that he will mention, and he'll prepare a fraud report. Then he'll prepare this fraud report within 2 days of coming to know about the fraud. Then he will send this fraud report to the board of directors or to the audit committee as a case may be, and he will ask them for their response within 45 days. So once the auditor gets the response within 45 days, then the fraud report which he has prepared plus the response which he got from the board or the audit committee as a case may be, plus his comments on that response, total 3 things: fraud report plus the response which we got from the board or the audit committee plus his comments on that response. These 3 things put together in one sealed envelope, he has to send it to the MCA. So this is about reporting to the central government. Okay, so the first part is clear. The first fraud has to be reported to the central government because value is at least 1 crore. Process also I have told you. Second fraud need not be reported to the central government because it was not found by the auditor in the course of audit. Now comes the last part, guys. This is a very small, minute, one single sentence which is written in your study material. Okay, it's one small point written in section 143 subsection 12. On that this question is framed. The concept goes like this. Read this part, this point over here, on this one point alone. If the auditor reports fraud to the central government in compliance with the above provisions in good faith, no duty to which he is subject to will be regarded as having been contravened. What does this mean? See, generally auditor has a duty of confidentiality. Confidentiality means whatever information, whatever he gets to know about the client, whatever he gets to know about the company in the course of audit, he is not supposed to go and disclose about it to others. He is supposed to keep it to himself. If required, he has to put it in the audit report, that's all. But he should not go and leak about it to the others. However, over here, in this case, there's a fraud in the company. About the fraud, he is going and reporting to the central government. Board of directors is saying that if you report like this to the central government, we will sue you for breach of duty of confidentiality. You are not maintaining confidentiality. You got to know about the fraud. No, keep it to yourself. Maintain confidentiality. Why are you going and disclosing about it to the central government? This is what the board is saying. Can the board say this? Is the board's argument right? No. The law very clearly says that if the auditor reports the fraud under section 143 subsection 12, then no duty is contravened. No duty that he is subject to is contravened. He has not violated any duty of his. We cannot say that just because he has reported the fraud to the central government, for this reason alone, we cannot say that he has breached the duty of confidentiality. We cannot say. So if the auditor reports fraud to the central government in compliance with the above provisions in good faith, no duty to which he is subject to will be regarded as having been contravened. Understanding, if Messrs. K&T Associates reports about the fraud to the central government, it cannot be said that they have breached their duty of confidentiality. So that was it about this question, guys. A nice interesting question, totally targeting on this one point in section 143 about fraud found by the auditors in the course of audit. Okay, now come to the next question, question number 11, a pure CSR question, a kind of a question which you would have never seen before. This is going to give you a different level of understanding altogether. Come on. The question says, Sunrise Pharma Limited, a listed company, has net worth of 400 crores and turnover of 800 crores in the preceding financial year 23-24. So net worth is 400 crores, turnover is 800 crores. It has provided the following additional data to you. In 23-24, that is same preceding financial year 23-24, net profit before tax is 55 crores, after tax is 38 crores. We know very well, for all purposes in CSR, we consider net profit before tax only, guys. Okay, so 23-24's net profit they have given, 22-23's net profit they have given, 21-22's net profit they have given. Then the question says, during 24-25, the company set up a skill development center as a part of its CSR initiatives. Okay, this project unexpectedly generated a surplus of rupees 0.80 crores, which the company has decided to reinvest into the same activity. Guys, the company is having surplus out of CSR, and that surplus company has reinvested back into the same CSR activity. Then the question says, board believes that since 0.80 crores is already being put back into CSR, company only needs to spend X minus 0.80 crores more on CSR during 24-25, where X is a minimum amount otherwise required. Understanding? So what is minimum amount required to be spent on CSR? 2%, guys. 2% of the average net profits of the 3 preceding financial years. See, I'll help you understand. Okay, what is X? X is the minimum amount otherwise required. What is the minimum amount which has to be spent on CSR? Minimum 2% of the average net profits of 3 preceding financial years. This is what has to be spent on CSR, minimum, right, guys? Current year we're talking about 24-25. So what is 3 preceding financial years? 23-24, 22-23, 21-22. So these 3 years, 3 preceding financial years, average net profit we will find. So 55 plus 48 plus 60. This is net profit of the 3 preceding financial years. Simple average we have to find. So 55 plus 48 plus 60 by 3. This is going to be 54.33 crores. What is this? This is the average net profit of 3 preceding financial years, 54.33 crores. Okay, 2% of this. This is the minimum amount which the company has to spend. So 2% of 54.33 crore is 1.09 crores. So this is a minimum amount which the company has to spend on CSR. Now what the board is saying is that 0.80 crores was a surplus out of CSR. That money we have already reinvested in the same CSR activity. So 0.80 crore we have already put in CSR. So the board is saying that now we have to spend more on CSR. How much? X, which is 1.09 crores minus 0.80 crores. X minus 0.80 crores. Board is saying that this balance, that is 1.09 crores minus 0.80 crores. How much will that be? That's going to be 0.29 crores, guys. So board is saying this much only we have to spend on CSR. Is the board right? Terribly wrong. Listen, board of directors, yes, no doubt, whatever is a surplus out of CSR, no doubt it has to be reinvested in CSR. Whatever is a surplus out of CSR, either it has to be plowed back into the same CSR project, or it has to be transferred into unspent CSR account, or it has to be transferred into some Schedule 7 fund. In this question, whatever is a surplus, they have reinvested in the same project. No, so they have plowed back into the same project. What you've done with the surplus is correct. But can this set off against the requirement to spend money on CSR? No. This 0.80 crore you reinvested into CSR, great. But over and above this, in addition to this 1.09 crore, the 2% number, anyways you have to spend on CSR. You cannot say that out of 1.09 crore, 0.8 I have already spent on CSR. So now I will spend only the balance 0.29 crore. You can't say. Because whatever you have reinvested into CSR, whatever is a surplus that you have earned out of CSR, if you have reinvested that into CSR, great. You've done correctly, but that cannot set off against the 2% requirement. So this 0.80 crore being reinvested in CSR is separate. This 1.09 crore to be spent on CSR is separate. Board cannot say that, out of 1.09 crore, 0.80 we have already put on CSR, only balance 0.29 CR only we will do. This is not going to be right. Okay, so the question is clear. The company is a listed company. They've given the net worth number, the turnover number and all. They've given us a net profit before tax and after tax, but we know we should not take net profit after tax. Then they have surplus from CSR 0.80 crores. Then this is the most interesting part of the question, where the board of directors are saying that if X is the minimum amount which we have to spend on CSR, we will not spend the whole X amount. From X we will subtract 0.80 crores, the surplus, and we will spend only the balance, which is incorrect. Now there are three things which the question is asking us. If the company is required to spend on CSR in 24-25, calculate the minimum amount to be spent on CSR. Two things they are asking us. If the company is required to spend on CSR, then what is the minimum amount to be spent on CSR? So first of all, should the company spend money on CSR or not? Is CSR obligation applicable on the company or not? CSR obligation will apply only if the company's net worth is at least 500 crores, or turnover is at least 1000 crores, or net profit is at least 5 crores in the preceding financial year. Now in this question, if you see, preceding financial year is 23-24. Net worth is 400 crores, guys. Is net worth at least 500 crores? No. Turnover is 800 crores, guys. Is turnover at least 1000 crores? No. But the net profit of the preceding financial year is 55 crores. Is it at least 5 crores? Yes. So even though net worth and turnover criteria is not fulfilled, net profit is at least 5 crores in the preceding financial year. Hence, yes, CSR obligation is applicable for the company. Now, if CSR obligation is applicable for the company, how much minimum amount they have to spend on CSR? We have already done the calculation. It is 2% of the average net profit of the three preceding financial years. Even we had calculated the same 54.33 crore number. This is the average net profit of the three preceding financial years. 2% of that number is 1.09 crore. This is a minimum amount which the company has to spend on CSR in the current year. Okay, this is it about your first subdivision, guys. Then comes the second subdivision. Comment on the decision of the company to reinvest the surplus in the same activity. Is it valid in law? Explain the applicable provision. See, out of CSR, by chance, if the company has any surplus, with that surplus, we can do only three things. That surplus shall not form part of the business profit of the company. Using that surplus, company can't distribute dividend and all. That surplus can be used only for three purposes. Either it has to be plowed back into the same project, or it has to be transferred into unspent CSR account, or it has to be put into some Schedule 7 fund like PM Cares fund and all. But in this question, the question says that whatever surplus they had, they reinvested back in the same CSR activity. So in this question, it has been plowed back into the same CSR project, which means point A. So what they have done in this question with the surplus is valid in law. They have reinvested it back into the same CSR project. It is perfect. Only thing is, they should not let it form part of the business profit of the company. Correct only they have done. The surplus is not forming part of the business profit of the company. The surplus is being reinvested into CSR. It is as per the provisions of the law. Perfect only. Then comes the third subdivision. Calculate the amount X minus 0.80 crores. First, calculate that amount X minus 0.80 crores. Comment on whether the company's interpretation that its obligation is X minus 0.80 crore, is it correct in law? Two things they are asking us. First, calculate the X minus 0.80 crores number. Then comment whether the company's interpretation that its obligation is so much only is correct in law or not. So first of all, what is X? X is a minimum amount which has to be spent on CSR, which we have calculated is 1.09 crores. So 1.09 crores minus 0.80 crores. So X minus 0.80 crore is 0.29 crores. Then is the company's contention right that it will spend only this much amount on CSR? No, it is not valid in law. 0.80 crore is being reinvested in CSR. That is different. 1.09 crore is minimum amount that has to be spent on CSR. It is different. Company cannot set off these two. While the surplus can be reinvested into the same CSR activity, it does not reduce or adjust against the 2% obligation, which means in this case 0.80 crore company has reinvested into CSR fine. In addition to this, over and above this 1.09 CR, this much minimum amount has to be spent on CSR. So company cannot say I will spend only the balance 0.29 crore. No, they are two different adjustments company. They are two different concepts company. Yes, you can reinvest your surplus back into CSR, but that amount which you're reinvesting into CSR cannot set off against the minimum CSR obligation. 1.09 crore you anyways have to spend on CSR. In addition to the 0.80 crore, 1.09 crore you anyways have to minimum spend on CSR. Okay, good question, guys. Come on, let's come to the next question now. Question number 12. Now, this question says Oceanic Textiles Limited issued a notice for its AGM. One of the key items on the agenda was declaration of final dividend. Notice was circulated to members through email. When the notice was received, a group of shareholders raised objections. Some shareholders complained that company failed to provide explanatory statement regarding the dividend. They argued that notice did not spell out in the explanatory statement details such as rate of dividend, basis of calculation, whether the dividend was being declared out of current year profits or from profits of earlier years. They insisted that without all this information being set out in the explanatory statement, notice of the meeting was defective. Some shareholders claimed that they never actually received the email and therefore insisted the company was in default. Board of Directors, however, maintained that the notice was fully compliant with the law, examined the situation and state whether the shareholders' objections are valid or whether the board's contention is correct. Okay, come on. What is two things in the question, guys? Only two things in the question. Thing number one, company sent the notice by email. Yes, it is allowed. Company can send the notice by email. Once a company sends the email, thereafter, whether the member has received the email or not, that is not the company's responsibility. Right, guys? This point over here. Company's obligation to serve the notice will be satisfied when it transmits the email. Company will not be held responsible for a failure in transmission beyond its control. Once a company sends an email, now your inbox, your email storage was full. That's why you did not receive the notice by email, not company's fault. The notice in the email went into your spam folder, not company's fault. So once a company transmits an email, now even if you don't receive it, it is not the company's fault. That is what has happened over here. Company has sent it by email. Some shareholders claimed that they never received the email and therefore insisted company was in default. No, company is not in default. Once company transmits the email, even if you don't receive the email, not the company's fault. So this point is simple, story over. Now comes a bigger point, the main point. This entire discussion about explanatory statement, final dividend. See, listen to me. There are four ordinary businesses, guys. What are the four ordinary businesses? Tell me. One is declaration of final dividend. This is an ordinary business. Then consideration of financial statements. This is also an ordinary business. Appointment of directors is also an ordinary business. Appointment of auditors and fixing their remuneration. This is also ordinary business. So four ordinary businesses we have. For these four ordinary businesses, explanatory statement is not required. Explanatory statement is required only for special businesses. So in this question, the matter is declaration of final dividend. This is an ordinary business. For ordinary business, anyways, explanatory statement is not required. So the shareholders are arguing that for this final dividend point, there was no explanatory statement, hence notice is invalid. Wrong. This is an ordinary business. For ordinary business, anyways, explanatory statement is not required. Explanatory statement is required only for each special business. So the shareholders' contention that for this dividend point there was no explanatory statement, that contention itself is not correct. Right, guys? So the board of directors contention is correct. The notice is perfectly valid. Email notice is also valid. Once a company transmits the email, whether the shareholder receives the email or not, that is not going to impact the validity of the notice. So even if the shareholders don't receive the email, the notice is still valid. And because dividend is an ordinary business, explanatory statement is not required, and hence a notice, even from that point of view, also is perfectly valid. Alright, now come to the 13th question. The question says Blue Wave Limited is a listed public company. It declared final dividend at its AGM on 15th July 24. However, certain shareholders did not receive the payment. The law says once a company declares a dividend, within 5 days the dividend has to be set aside in a separate bank account, and once a company declares dividend, within 30 days company must make the payment of the dividend, or the company must dispatch the dividend warrant, guys. But here the question says even though the company has declared final dividend, certain shareholders did not receive the payment. Come on, let's see who did not receive the payment. Ms. Bhavana did not receive her dividend because company had adjusted her dividend against dues payable by her towards goods purchased from the company's consumer division, for which she was in default of payment. Come on, guys, try to recall. Generally, if the dividend is not paid on time, if it is not paid within 30 days, then there will be heavy punishment under section 127, guys. Company will also be punished. The directors and officers in default will also be punished. But however, there are some 5 situations we learnt wherein even if the company does not make the payment of dividend, still it will be perfectly fine. There will be no violation. There will be no punishment. One of those cases is that if the company has lawfully adjusted the dividend money against any sum due to it by the shareholder, which means company has to pay dividend to the shareholder if the company also has a receivable from the shareholder, like if the company has to receive call money from the shareholder, or in this question company has to receive money for the goods from the shareholder. So company has a receivable from the shareholder, company has a payable of dividend, company has a receivable from the shareholder, company can set off the dividend payable against the receivable. So if the company has lawfully adjusted the dividend amount against any sum which is due to the company by the shareholder, then there will be no punishment under section 127. So section 127 punishment will not apply in the first case over here. Company is allowed to adjust the dividend payable against any money which it has to receive from the shareholder. Then come the second point. Mr. Chandan, a shareholder, had not updated his bank account details despite repeated reminders by the company. So even this is covered in one of those 5 situations, guys. If the shareholder has given directions to the company regarding payment of dividend, and if those directions cannot be complied with, and if the same has been communicated to him, then section 127 punishment will not apply. See, guys, I'll help you remember, okay. Under section 127 we have punishment. The punishment will come into the picture if the company has declared dividend but has not paid the dividend within 30 days, or has not posted the dividend warrant within 30 days of declaration. That is when section 127 punishment will come into the picture. And what is the section 127 punishment? See, company will be punished with 18% per annum interest for the period of default. The directors who are knowingly a party to the default, they will be punished with imprisonment and fine. Not or fine, it is imprisonment and fine. Imprisonment will be maximum 2 years. Fine will be 1000 rupees per day of the default. Interesting point, 2 interesting points about this punishment. Interesting point number 1, it is imprisonment and fine. It is not imprisonment or fine. Interesting point number 2 is, for imprisonment there is maximum limit, maximum 2 years. But for fine, there is no maximum limit. It's just 1000 rupees per day. That's all. No maximum limit on the fine. Okay. Now this is a punishment under section 127. But even if the company has not made the payment of dividend within 30 days, even if the company has not posted the dividend warrant within 30 days, still no punishment. Section 127 will not apply in 5 situations, guys. What are those 5 situations? Number 1, if the company did not make the payment of dividend because of operation of law. Operation of law. Number 2, the shareholder gave some direction to the company. The direction could not be complied with, and the company has communicated about this to the shareholder. Number 3, the company did not make the payment of dividend because some legal case is going on, some legal dispute is going on about the right to receive dividend maybe. Fourth point, company has lawfully adjusted the money the dividend amount against an amount which the shareholder owes to the company, same like the first situation over here, Miss Bhavna. Then last point, any other reason which is not the company's default. So in these 5 cases, even if the company does not make the payment of dividend within 30 days, still no punishment. Now in this situation, guys, in the subdivision B, the shareholder Chandan, he has given a direction to the company that remit the dividend money to my bank account details, but he has not updated those bank account details, and company has given him reminders also. So this will straight away fit in this second point over here, wherein the shareholder has given directions to the company. Those directions cannot be complied with, and the same has been communicated to the shareholder. So therefore in this case, even if the company is unable to pay the dividend now within 30 days, still section 127 punishment will not apply. Okay, so this question is straight away testing you on this section 127 5 cases only. Alright, then come to question number 14. The question says Starlight Electronics Limited, a listed public company, registered office in Mumbai, has been facing serious debates in its board meetings about compliance with Companies Act 2013. Board has recently shifted most of its operations to Bangalore, and some directors insist that it would be far more convenient to keep the company's books of accounts there instead of the registered office in Mumbai. Come on guys, section 128, books of accounts. Where should the books of accounts be kept? At the registered office or at any other place in India? Who will decide? Board of directors will decide by passing a board resolution, and then within 7 days of that board resolution, ROC has to be informed about the new address now where the books are going to be kept. So this company's registered office is in Mumbai. Either the books have to be kept in Mumbai or the books can be kept in any other place in India, provided the board of directors pass a board resolution to this effect. So they are arguing that they want to keep the books in Bangalore. Meanwhile, accounts team has quietly been following a space-saving policy, destroying all financial records that are more than 5 years old, arguing that such records are anyways useless for business. Terrible. Books of accounts of the company have to be preserved for at least 8 years. If central government has ordered investigation, in those cases central government can order preservation of books for more than 8 years also. So they are destroying all records which are 5 years old. This is wrong. Books of accounts have to be kept for minimum 8 years. As the compliance officer, advise the board of Starlight Electronics Limited on these practices in the light of provisions of Companies Act. 2 things are testing us on. Number 1, where should we keep the books of accounts? And number 2, preservation of books of accounts. Come on guys, come on, let's have a look at the answer. So first point, every company will keep the books of accounts in the registered office, or they can keep it at any other place also, but in India, which the board of directors will decide. And once the board of directors has decided to keep the books in some other place in India, then in that case they have to inform ROC about the full address of that some other place within 7 days. So in this case, if you see, the company's books of accounts are originally, right now they are being kept in the registered office in Mumbai. They want to shift it to Bangalore. They can shift it provided it is so decided by the board of directors, and they also have to inform to ROC about it. So yes, no problem at all, no tension at all. They can shift the books of accounts to the Bangalore office, just that the board has to make a decision about this and inform the ROC about it within 7 days. Okay, then comes the second point, preservation of books of accounts. Books of accounts of the company are to be preserved for at least 8 financial years. If central government orders investigation, in those cases it can be for more than 8 years also. In this question, they're destroying all the records which are 5 years old. They have to be preserved in good order for minimum 8 financial years. So destroying in 5 years itself will not be in compliance of the provisions of the Act. Okay guys, so this was your question number 14 on section 128, testing you on 2 things. Number 1, the place of keeping the books of accounts, and number 2, the period of preservation. Okay, now come to the 15th question, the last descriptive question. The question says Vision Limited, a public company, is in the process of appointing statutory auditor. During discussions, the following facts came to light. One of the proposed partners of the audit firm holds preference shares of 1.5 lakhs in Vision Limited's holding company in his own name. Another partner of the said firm is a brother of Mr. Raj, who is a finance director of Vision Limited. Board is confused whether these situations would disqualify the audit firm from being appointed. Basically, the question is about Disqualification of auditor. First subdivision. Examine whether holding of preference shares by a partner affects the firm's eligibility for appointment as auditor. Second subdivision. Examine whether relationship of partner with the finance director has any impact on disqualification under section 141. Basically, in both of these cases, we have to decide whether any disqualification is attracted or not. Listen now. Let's talk about the first point. The partner is holding preference shares of 1.5 lakhs, not in the company. They're holding only in the company's holding company. Okay, so the provision goes like this. A person who himself or his relatives or his partners, if they hold any security or interest in the company or in the associate company or subsidiary company or holding company or subsidiary of holding company, will be disqualified to be appointed as auditor of the company. That is, neither I myself, nor my relatives, nor my partners. None of us should hold any securities in cash, that is company, associate company, subsidiary company, holding company, also in any other subsidiary of the holding company. You have the 1 lakh point, right? That 1 lakh point is only for relatives. It is not for the auditor himself. It is not for the partners of the audit firm, guys. So in this question, if you see, the partner is holding preference shares in the holding company. So there is clearly a violation. The violation is the partner is holding securities in the holding company. So therefore, this audit firm will be disqualified. It will not be eligible to be appointed as auditor. We can't appoint them as auditor. Okay. That's the first subdivision. Because the partner is holding any security. See, just because it is preference shares, will your answer change? No. Debentures, preference shares, equity shares, it can be any kind of security. If I myself or my relatives or my partners, if any of us hold any security in cash or in subsidiary of holding company, then the firm will be disqualified from being appointed as auditor. Alright, 1 lakh point is only for relatives. Okay. Then comes the second subdivision. There is a point in the disqualifications list only which says very clearly, a person whose relative is a director or key managerial personnel of the company, that person will be disqualified. Basically, there's a person, Mr. Green, let's say. His relative, this person, Mr. Green, has a relative. This relative is either a director of the company or he's a KMP of the company. Then in that case, this person, he will be disqualified. He cannot be appointed as an auditor. Understanding? Any person whose relative is a director or KMP of the company, that person will be disqualified from being appointed as an auditor. Now, in this question, the situation says another partner of the firm is a brother of Mr. Raj, who is a finance director of Vision Limited. So, a partner's relative is a director of the company. That firm will be disqualified. So, as partner of the proposed audit firm is a relative of the director of Vision Limited, the proposed audit firm is disqualified. So, in both the situations, a disqualification is attracted. In the first situation, disqualification is attracted because neither the auditor nor his relatives nor its partners, none of them are supposed to hold any securities or interest in cash or subsidiary of holding company. Here, the partner is having preference shares in the holding company. Therefore, the firm is disqualified. In the second situation, if you see, the partner, he is related to the director or KMP of the company. He is related to the finance director of the company. Therefore, the firm is disqualified. Any person who is related to the director or to the KMP of the company will be disqualified. See, if the partner over here was related to some other employee in the company, let's say he is related to the cashier in the company, or let's say he is related to some clerk in the company, then there is no disqualification. Disqualification will be attracted only if you are related to the director or KMP of the company. Then only you will attract a disqualification. Here the partner is related to the finance director. He is related to a director or KMP of the company. Therefore, disqualification will be attracted. Okay. So these are your descriptive questions in the second test. Now come on, let's come to the case-based MCQs. Even over here we have 3 stories, guys. Let's see them one by one. Look at the first story over here. The question says Crystal Build Tech Limited, a public company, has been aggressively expanding into luxury housing projects. To fund its ambitions, company borrowed large sums from banks and financial institutions. On 15th April 24, company created a floating charge over its stock of cement, steel and work in progress in favor of ABC Bank. Clearly, it's a floating charge, guys, because the charge is created on the current assets of the company. When the board met, one director casually remarked, "Oh, floating charges are temporary anyway, so no need to register them." This is wrong, guys. Whether the charge is a fixed charge, whether it is a floating charge, all charges have to be registered. Then the question says, on the 20th of May 24, company mortgaged a prime immovable property located in Singapore in favor of XYZ Bank. The CFO confidently declared that since the property lies outside India, ROC in India has nothing to do with it. Even this is wrong. Whether the asset is in India or outside India doesn't matter. If charge is created on any asset, then it has to be registered with the ROC. So even though the asset is in Singapore, even if it is outside India, even this has to be registered with ROC. So again, there's a violation over here. And then the question says, when the statutory auditors reviewed the records, they pointed out that every charge must be registered within 30 days of creation, failing which the company must seek condonation. The CS rushed to file the charges but missed even the extended 30 plus 30 days deadline. Matter was escalated to the ROC, who indicated that there may still be one last opportunity available to the company, though on stricter terms. Guys, what are they talking about? Come on, try to recall. From the date of creation of charge, within 30 days we are supposed to register the charge, guys. In that case, we'll have to pay fees. But if we are unable to register within these 30 days, we can register within the next 30 days, in which case we'll have an extra requirement of paying additional fees. If we don't register within these extra 30 days also, then we can register within the next 60 days. But for that, we have to pay ad valorem fees. Remember? Yes, so this is what they're talking about, that they could not do the registration within this 30 plus 30 days, and they're having one last opportunity, which is this last 60 days. But on stricter terms, what is a stricter term? They'll have to pay ad valorem fees. In the midst of this, a heated debate broke out among the directors. Varun argued that if the charges are not registered, the entire loan becomes void. Tarun immediately corrected him, saying, "No, the debt is still valid, but the charge itself is void against a liquidator and creditors." Tell me, guys, between Varun and Tarun, who is right? Varun is saying that if the charge is not registered, the loan itself is void. Tarun is saying if the charge is not registered, the debt is still valid. Only the charge becomes void. Who is right over here? Varun is wrong. If the charge is not registered, the loan does not become void. The loan is still valid. Only the charge becomes void. Only the security becomes void. That is, it is still a loan, just that we will treat it as if it is an unsecured loan. So Varun is wrong over here. Tarun is perfectly right. Only the charge will become void. The loan will still remain valid only. Okay, now come on, have a look at the questions. We have 4 questions under this. The floating charge created on stock and work in progress in favor of ABC Bank must be registered, guys. Yes, whether floating charge, whether fixed charge, both should be registered. So registered. So it can't be B, it can't be D. A says registered since floating charges are also covered under section 77. Yes. Registered only if it exceeds 1 crore. No, there is no monetary limit. So option A. Then, mortgage created on immovable property in Singapore, even that has to be registered. So, need not be registered is wrong. Must be registered is right. Must be registered with ROC in India, since every charge created by an Indian company must be registered regardless of asset location. Then option C says can be registered either in India or Singapore. No. Registration depends on Singapore law. No. Option B. Then comes the third question. In the case above, one second. Let me zoom it a little bit for you because we're doing MCQs only now. Look at this. I think it'll be a little better for you. Come to the third question. In the case above, after the company missed both the normal 30-day period and the further 30-day period with additional fees, the matter was escalated to the ROC. ROC indicated that there may still be one last opportunity available, but only on stricter terms. What does this mean in law? We've discussed this already. It's nothing but the next 60 days, but for that you have to pay ad valorem fees. So a further 60 days may be given, but the company must pay ad valorem fees based on the amount secured. Then comes the fourth question between Varun and Tarun, who is correct. We've already discussed this also, that Varun is wrong. If charge is not registered, the loan does not become void. Loan is still valid. Only the charge becomes void. That is, we will start treating the loan as if it is unsecured loan. So Varun is wrong, Tarun is right. Okay, this was your first case-based MCQ. Then come to the second one. The question says Sky High Motors Inc., a multinational automobile company incorporated in Germany, has recently opened its first branch office in Bangalore to explore the Indian electric vehicle market. The grand opening was flashy, ribbon cut by a Bollywood star, headlines in every newspaper. But behind the glamour, compliance issues started surfacing. The Indian company secretary, newly appointed to the branch, warned the German board, now that you've set up a place of business in India, you must report this fact to the registrar of companies within a strict timeline. Come on, guys. It's a multinational automobile company. It's a company incorporated outside India. It is setting up its place of business in India. It is going to do business activity in India. This becomes a foreign company, guys. Within 30 days of establishing a place of business in India, it has to file Form FC1 with Central Registration Center, CRC. Remember? Yes, guys. Meanwhile, CFO of the German parent assumed that filing requirements were the same as Indian company. He told the team, don't worry, we'll file our annual return within 60 days from our AGM, just like every other Indian company. Wrong. Foreign companies have to file annual return within 60 days from the end of the financial year, not from 60 days from the date of AGM. Wrong. Then the question says, finally a debate broke out in the boardroom. Some directors argued that since Sky High is already audited in Germany, they need not get their Indian accounts separately audited. Others counted that the Companies Act might still require it no matter what the German auditors do. To the extent of the Indian business, they do have to get audit done. Compliance clock is ticking. Directors are now under pressure to get their facts straight. Come on, look at the questions. After establishing first place of business in India, within how many days must Sky High Motors Inc. file Form FC1 and with whom? Form FC1 has to be filed within 30 days, guys. Within 30 days with whom? With CRC, ROC Central Registration Center, option C. Everything else has to be filed with ROC New Delhi. This Form FC1 alone has to be filed with ROC Central Registration Center. Then comes the next point. Is a CFO right regarding the filing of annual return? No. The annual return for these foreign companies, annual return has to be filed within 60 days from the end of the financial year. So is the CFO right regarding annual return? No. So no, it can't be yes. No, CFO is wrong. For foreign companies, annual return must be filed within 60 days from the end of the financial year. Correct, guys. CFO is partly right. No, CFO is completely wrong. Foreign companies are not required to file annual return. Terrible. They have to file annual return within 60 days from the end of the financial year. For Indian companies, it is 60 days from the AGM. For a foreign company, 60 days from the end of the financial year. Okay. Then comes question number 7. With respect to audit of accounts, what is the correct position for Sky High Motors Inc.? Since its accounts are audited in Germany, no audit is required in India. Wrong. It must prepare a balance sheet and P&L for Indian operations and get them audited by a practicing CA in India. Option B, guys. If it's a foreign company, whatever are its Indian operations, for Indian operations alone, the books of accounts, the financial statements have to be audited. Okay, so option B. Then comes a third case study. Green Glow Limited, a public company, had been struggling with liquidity. It defaulted on repayment of deposits taken from its members in 2022. In March 24, after finally clearing all outstanding deposits with interest, board considered declaring dividend to pacify angry shareholders. Meanwhile, its subsidiary, Green Glow Foundation, was registered as a Section 8 company to promote education and rural development. Some directors casually suggested that even the foundation can declare small dividend. Prohibited. Section 8 company is prohibited. Section 8 company cannot declare dividend. See, this point is about Section 8 companies, guys. Can't declare dividend. What is this point about? There is a provision in our dividends chapter. You must have learned that if the company has defaulted in repayment of deposits, company has to first rectify the default. Once the company rectifies the default relating to deposits, only then the company can declare dividend. Now in this case, the company has rectified the default, right? The question says in March 24, after finally clearing all outstanding deposits. So company has rectified the default. Now the board is declaring dividend. So this is fine, because you can, if there's a default relating to deposits, you can't declare dividend. But once you rectify the default, you can declare dividend. So here, because the default is rectified, board can declare the dividend. All right. So looking at the options now, in the above scenario, which of the following statements is correct? Green Glow Limited cannot declare dividend at all since it had once defaulted on deposits, even though default has now been rectified. No, once default is rectified, you can declare deposits. Both Green Glow Limited and Green Glow Foundation can declare dividends once the defaults are cleared. No, Green Glow Foundation is a Section 8 company. Section 8 company, it is prohibited, they just can't declare dividends. Then Green Glow Limited may declare dividend after clearing the deposit default, but Green Glow Foundation is prohibited from declaring any dividend. Option C. The first company, because the deposit default is rectified, you can declare dividend, but the second company, because it's a Section 8 company, it is prohibited from declaring dividend. Option C. Alright, so this is it with your second test, guys. These questions were on your charges chapter, management and administration, dividend, accounts, auditors and companies incorporated outside India. Next, we'll take up the third test. Third test is on LLP and other laws. So starting off with our discussion on the third test now, even over here, we'll straight away go to the descriptive questions. We'll come to the MCQs a little later. Come to the descriptive questions now. Come to question number 9. A nice question, guys, focusing on General Clauses Act, the previous publication concept. I'll give you a quick reminder about the concept. We had learned that in General Clauses Act, sometimes a particular law may give power to an authority to make rules. But that authority may be subject to previous publication, which means that authority can make rules but subject to previous publication, which indicates that the authority has to first publish a draft of the rules for the information of the public. Then the authority will tell the public that by this date they have to send their objections or suggestions, as the case may be. Then the authority will consider those objections and suggestions, incorporate the changes in the draft rules wherever required, and then they will publish the final rules. This is a very brief discussion of the previous publication concept, guys. Keep this brief in your mind and have a look at the question. The question says Metro Transport Authority, empowered under a state act, was authorized to frame rules for regulating e-rickshaw services subject to the condition of previous publication. What does this indicate? We have an authority in front of us. Metro Transport Authority. This authority has a power to make rules, but this power is subject to previous publication, which means when this authority makes these rules, they first have to publish the draft, follow the whole process of previous publication, then only they can make the final rules. Okay, in its haste to implement the rules, the authority did three things. Number one, it published a draft in the official gazette, but it did not publish any notice specifying the date by which the objections or suggestions would be considered. Terrible. This is going to be a default. When they publish the draft, they should also give a date. They should also give a date on or after which the draft will be taken into consideration, which means they have to mention a date by which objections and suggestions the public has to send. Here they have published the draft, but they did not even mention the date. So definitely there's a default, guys. Along with the draft, a notice shall be published specifying date on or after which the draft will be taken into consideration. Default number one. Then the question says, when a few objections were nevertheless received from the transport unions, the authority ignored them and directly published the final rules. Guys, when the authority publishes the draft, they will get objections and suggestions from the general public. It is not mandatory that they have to listen to each and every objection, each and every suggestion, not possible also. But at least they have to consider them, and whichever is relevant, whichever can be incorporated, they have to incorporate. They at least have to consider. They can't straight away, put the suggestions into the dustbin. They have to at least consider the suggestions. But here the authority received some objections, they received some suggestions from transport unions, but they straight away ignored. They did not even consider. This is another default, guys. Right? Then the third thing that the authority did, the authority made major changes in the final rules compared to the draft, introducing provisions that were not even remotely related to the subject matter. This is very, very important. Listen to me carefully. We have the draft and we have the final rules. There may be some changes between them. Of course, there will be some changes between them, but if those changes are ancillary and if those changes are not foreign to subject matter, keywords, okay, if they're ancillary, if they're not foreign to subject matter, which means the changes are connected to the subject matter, then in that case, guys, they don't have to republish the draft. They can straight away publish the final rules only. But here, however, in this question, the authority has made major changes, which means they are not just ancillary changes, they're not just interconnected changes, they are major changes and they're not even remotely related to the subject matter. The changes are not even related to the subject matter, which means the changes are foreign to the subject matter, guys. So therefore, they have to republish the draft. They can't straight away publish the final rules. They have to republish the draft. So 3 defaults they have committed over here. And then the question says, several unions have challenged the validity of these rules before the High Court, analyze the requirements of GC Act, examine whether the Metro Transport Authority has complied with the law. No, it has not complied with the law. Yes, it has published the draft correctly, but however, along with the draft, it should also give a notice specifying the date on or after which the draft will be taken into consideration, which means anybody in the general public, if they want to send any objections or suggestions, they should send those objections or suggestions before that specified date. Then so the first problem, the first default in the question was that they did not even give any notice specifying the date. They did not even give any date by which the objections should be received. First default. Second problem, when they receive any objections or suggestions, they must at least consider those objections or suggestions. But here what did they do in this question? They straight away ignored the objections and suggestions. Second default. Third default, between the draft and the final rules, there will be some changes. But if those changes are ancillary and if those changes are not foreign to the subject matter, then no need to republish the draft. You can straight away publish the final rules. But however, if the changes are major, if the changes are foreign to the subject matter, then in that case they have to republish the draft. So in this question, the situation says that there are major changes between the draft and the final rules. There are major changes and there are more provisions which are not even related to the subject matter, which means the changes are foreign to the subject matter. They're not even connected to the subject matter. In simple words, significant changes have happened. If there are significant changes between the draft and the final rules, they have to republish the rules. They have to republish the amended draft. They can't straight away publish the final rules. So this was a third default. So there are 3 problems. There are 3 non-compliances over here. So look at the last part over here. As the changes are significant and are foreign to the subject matter, once again the draft with the changes should have been republished. Authority cannot directly publish the final rules if there are major changes. Got it, guys? So this was a nice question on previous publication. Now come to question number 10. Another question relating to GC Act, guys. Now this question will test our knowledge on may and shall. Let's read the question. The question says, the Riverfront Conservation Act was enacted with specific objective of ensuring clean rivers and protecting public health. So what is the objective of the act? The objective of the act is ensuring clean rivers and protecting public health. This is the objective of the act. Section 12 of the Act states that the Pollution Control Board may issue directions to immediately stop discharge of untreated waste into the river if it is satisfied that such discharge is harmful. So guys, there's an act. This act's objective is to ensure clean rivers and protect public health. One section in this act says that the Pollution Control Board may issue directions to immediately stop discharge of untreated waste into the river if it is satisfied that the discharge is harmful. In practice, several factories were found directly discharging untreated chemical waste into the river. Despite inspection reports confirming the danger, board chose not to issue any directions, arguing that the law uses the word may and therefore gives it discretion. Local environmental groups have filed a petition before the High Court claiming that in such circumstances, board is under a legal obligation to act and that may should be interpreted as shall. Examine whether the board's defense is sustainable. Come on, guys. Interpretation of the word may and shall. Come on, let's discuss this. Rule of exceptional construction. Come on. Interpretation of statutes chapter. Yes. See, the provision goes like this. Generally, the word may indicates it's a directory provision, Right guys, if I put the word may in any provision, it indicates it is a directory provision, and generally the word shall indicates that it is a mandatory provision. Okay, so if here in this question in section 12 it is the word may is used. So because the word may is used, it is a discretionary provision, it is a directory provision, which means it is not a mandatory provision. But however, we should not literally read the law every time. If literally reading the law, if giving the word may a directory meaning is defeating the objective of the legislature, then we should depart from the words of the law and we should try to find the real intention of the lawmaker, guys. Understanding, like for example, let me help you understand in the point of view of this question. The whole objective of the law is what? To ensure clean river and protecting public health. Okay, now the section 12 uses the word may, which means it gives discretionary power to the pollution control board. It is not mandatory, it's only discretionary, that if they want they can issue directions to those factories that are discharging untreated waste into the river if it is satisfied that such discharge is harmful. Now the word used over here is may, which means it is optional. It is not mandatory, it is optional. So which means don't you think it is a little weird, because even if the factory, let's say, is discharging untreated waste into the river, even though the river is getting polluted, still I am giving the pollution control board an optional duty that if they want they can issue directions. Don't you think giving it an optional meaning will defeat the objective of the law? Because what is the objective of the law, guys? The objective of the law is to ensure clean rivers. So if the rivers are getting polluted, then the pollution control board has to issue directions to stop the discharge of untreated waste into the river. So giving the word may over here a discretionary meaning, giving the word may over here an optional meaning is defeating the object of the statute, because the whole objective of the statute is that we must ensure clean rivers. So if I say that, okay, even though the factory is, polluting the river, still it's up to the pollution board, it's up to the pollution control board whether they want to give directions or not. It's up to them. If I give the word may over here an optional meaning, I'm defeating the objective of the legislature. This can't be the objective of the legislature. So that is why even though the word may is used over here, we will interpret it as if it is shall, applying the rule of exceptional construction, and it is mandatory now for the pollution control board to issue directions. Understanding, if it is interpreted as a directory provision, the objective of the act, which is to ensure clean rivers and protecting public health, will get defeated. Hence, the word may must be read as shall. Substance over form, guys. Always substance over form. We must give the words that interpretation that will help us achieve the objective of the legislature. We should put ourselves into the shoes of the lawmaker and think from his point of view that what was his intention while making the act. Taking guidance from that interpretation, we are supposed to give meaning to the words. Right, guys? So here in this case, if we give the word may a directory meaning, we will not be able to meet the objective of the lawmaker. We will not be able to meet the intention of the lawmaker. The objective will get defeated. So that is why the pollution control board, it is mandatory. They have to give directions to immediately stop the discharge of untreated chemical waste into the river. Only then the objective of the act will get defeated. Understanding, everybody? Yes. So this was your interpretation of the word may and shall. Now come on, have a look at the next question. A question from FEMA. Arjun Exports Private Limited, a company in Chennai, is exploring 2 international payments under FEMA. It proposes to remit $100,000 for purchase of lottery tickets. Guys, remittance of foreign currency to purchase lottery tickets, prohibited transaction, guys. This is going to be a current account transaction. A current account transaction, schedule 1 current account transaction, prohibited transaction. You're not allowed to make an outward remittance of foreign exchange to purchase lottery tickets or sweepstakes or football pools or banned or prescribed magazines. That point. Then there's one more point over here. At the same time, it wishes to remit $5 million as consultancy fees to a foreign architect for designing upcoming luxury infrastructure project in India. Extremely important from the examination point of view. Listen to me carefully. See, try to recall in your current account transactions, you have Schedule 1, prohibited transactions. Schedule 2, those current account transactions which you can do, but you require central government approval. Schedule 3 transactions, those transactions for which you require RBI approval. In Schedule 3, I teach you as Part 1, Part 2. Part 1 is for individuals. Part 2 is for non-individuals. In non-individuals point, you have one of the points as consultancy services. Any remittance for payment of consultancy services, there you have two branches coming out. One is for consultancy services relating to infrastructure projects, and then consultancy services not relating to infrastructure project others. Okay, if the person is a non-individual and if you are making remittance for consultancy services, if it is relating to infrastructure projects, then up to $10 million you can remit without any RBI approval. More than $10 million only RBI approval is required. But if it is a remittance for consultancy services not relating to infrastructure, for this you have the $1 million limit, guys. If you're making an outward remittance of foreign currency or foreign exchange, if it is within this limit, then RBI approval is not required. If it is more than this limit, only then RBI approval is required. Okay, so over here your person is Arjun Exports Private Limited. It is a non-individual. It's making a remittance for consultancy fees relating to infrastructure. So therefore this 10 million limit will apply. But it is $5 million only. They're emitting $5 million only. It is within the limit of $10 million. As it is within $10 million, therefore RBI approval will not be required. They can freely make the remittance of this foreign exchange. They do not require any RBI approval. Okay. So 2 points over here. Number 1, remittance for purchase of lottery tickets, prohibited current account transaction. Number 2, remittance of consultancy services charges relating to infrastructure project, permitted. Up to $10 million permitted. Here it is $5 million only. So they can freely make the remittance. No RBI approval is required. Had it been more than $10 million, then yes, RBI approval would be required. Okay. This was your question number 11. Now come to question number 12, a question on LLP Act, guys. This question is targeting compounding of offences, a very, very important concept relating to LLP. Let's read the question first. The question says, Bright Sparks LLP, engaged in consultancy services, failed to file its statement of accounts and solvency within the prescribed time for financial year 22-23. The registrar issued notices and the LLP applied for compounding of the offence since a contravention was punishable with fine only. Why have they mentioned this? Compounding of offence is possible only for those offences which are punishable with fine only. If the offence is punished with imprisonment, then no concept of compounding. Compounding concept itself you can apply only for those offences which are punished with fine only. Okay, that's why they have mentioned that the contravention was punished with fine only, and that is why they applied for compounding of offences. The following events unfolded. LLP applied to the ROC, who forwarded the matter to the regional director. The regional director compounded the offence by collecting a fee equal to the minimum prescribed fine. Meanwhile, one partner argued that since prosecution had not yet been initiated in court, compounding was not possible. Another partner insisted that even if prosecution has already started, offence could still be compounded. RD, after compounding the offence, directed the LLP to file the pending statement of accounts and solvency within 15 days. LLP ignored the direction. The partners are now confused about the legal consequences. Advise Bright Spark LLP with reference to the LLP Act, provisions on compounding of offences, specifically addressing 3 things. Number 1, what kind of offences can be compoundable? I just discussed with you only those offences which are punished with fine only these kind of offences can be compounded. This is a simple point. Then the next question is asking us whether compounding is possible before or after institution of prosecution. Let me slowly explain this point to you, because as soon as you see this word prosecution, here itself half of you will give up. So listen to me very carefully. For the purpose of this section, okay, prosecution is nothing but filing a case. Interpret it in that manner, you will understand in a much easier manner. See, imagine a situation where, let's say there's an LLP. This LLP has done an offense, okay, and till now any case has not been filed till now, okay. There's an LLP. The LLP has done an offense, and till now a case has not been filed in the court. All right, you can straight away go and get the offense compounded. No tension. So if the case is not filed till now, then you can get the offense compounded. You can follow the process, file the application with ROC. ROC will forward it to the RD, and the RD will compound the offense for you, no problem. But what if the case is already filed in the court and the case is still going on? Which means, what if the prosecution is still going on? What if the prosecution has been instituted? That means, what if the case has been filed? Then in that case, if the case is still going on, even now, even in this process, While the case is going on one side, on the other side, you can go and get the offense compounded. Once the offense is compounded, then the ROC will inform the court that like this, the offense got compounded, and once the court is informed about this, the court will close the case and discharge the offender. Story over. So which means now what's the conclusion? When can we compound the offense? Can we compound the offense before prosecution is instituted? Yes. Before the case is filed, before the prosecution is instituted, we can get the offense compounded, no problem. So yes, we can get compounding done before the prosecution is instituted. Now can we get the compounding done after the institution of prosecution? After the case is filed? Yes. After the case is filed, then also we can get the offense compounded. In that case, once the offense is compounded, ROC will inform about this to the court, and the court will discharge the offender and close the case. So, whether compounding is possible before or after institution of prosecution, it is possible both. It is possible before instituting prosecution also, it is possible after instituting prosecution also. Okay, and then comes your last subdivision, consequence of failing to comply with RD's direction after compounding. Oh, this is very interesting. Look at this. In this question, what was the offense, guys? LLP had not filed the statement of accounts and solvency within the applicable time. That was a whole offense. So RD, after compounding the offense, directed the LLP to file the pending statement of accounts and solvency within 15 days. Simple point, guys. The default over here is that the LLP has not filed statement of accounts and solvency. So RD is willing to compound the offense, but RD is saying within 15 days now you have to file the statement. But however, the LLP ignored the direction. LLP is not filing the statement. So this is going to be a very serious issue, guys. Severe punishment will enter into such kind of cases. See, if the RD is giving an instruction, or if the RD is giving a direction to the LLP or to the designated partner or to the employee of the LLP to do the filing of the statement or the accounts, as a case may be, within a prescribed time, if they don't do the filing within the prescribed time, forget about compounding. Your punishment will become double. Your fine will become double. So, RD may direct filing of the pending account within prescribed time. If LLP fails to comply, law provides that maximum fine will become twice the amount prescribed in the relevant section. In this case, ignoring RD's direction exposes Bright Spark LLP to double the maximum fine. Understanding, the problem over here is LLP did not file the statement of accounts and solvency with the ROC on time. So RD is willing to compound the offense, but RD is saying you have to file the statement now within 15 days. LLP is not filing. If RD gives a direction like this, and if this direction is not complied with, if they don't do the filing within the prescribed time, then forget about compounding. Instead, the fine will become double. So LLP will have to now bear double the fine. Alright, so this was your discussion with respect to compounding question number 12. Now come to question number 13, define foreign exchange. Simple point, guys, straightforward question. This is definition of foreign exchange. You can straight away see it over here. Then come to question number 14. Now this is very important. This is about Repeal General Clauses Act. The old Taxation Act 1960 was repealed by the newly enacted Goods and Services Regulations Act 2023. After the repeal came into effect, several issues arose. 1, 2, 3 issues arose. Examine these disputes with reference to the General Clauses Act 1897. It's all about repeal, guys. Mr. Arjun, who had already filed his tax return under the old act in 2022, argued that since a law was repealed, all acts done under it have become invalid. Is he right, guys? Whatever you do under the old act, does it become invalid? No. Repeal does not affect anything already done or performed under the repealed act. This is the very first point in the effect of repeal. Repeal does not affect anything which is already done or performed under the repealed act. So under the old act, if you have filed any returns, those returns will still be perfectly valid. They will not become void. So this is what Arjun is saying over here is not valid. Arjun's claim is incorrect. Then Miss Kavya had a pending claim for refund under the old act, and she feared it would lapse with the repeal. Even this will not lapse. Under the old act, whatever claim you have, whatever privileges, responsibilities or debts you have, they will still continue. Repeal does not affect any CPRD. If you've attended any of my classes, this is how I would have taught you this point as CPRD. So repeal does not affect any CPRD, claim, privilege, responsibility or debt under the old act. It will still continue. So Ms. Kavya, if she's having any claim for refund under the old act, she's having some claim under the old act, it will still continue. It will not get affected. Then comes the third point. The tax authority initiated an inquiry in 2022 under the old act against certain fraudulent transactions but could not complete it before repeal. The company being investigated claimed that inquiry cannot continue after repeal. This is important. Read it once again. The tax authority had initiated an inquiry in 2022 under the old act against certain fraudulent transactions but could not complete it before the repeal. So before the repeal itself, inquiry they started, but they did not finish the inquiry. Company being investigated claimed that inquiry cannot continue after the repeal. Wrong, guys. Even if the old act has been repealed, still it will not affect any RIL. Remember, remedy, inquiry, litigation, which is already initiated before the repeal. So before the repeal could have happened, before the act could be repealed, before that itself, an inquiry was instituted. That inquiry will not get affected. Repeal will not affect any inquiry, litigation, or remedy which was instituted even before the repeal. So this inquiry will still continue. Tax authority will still continue this inquiry. The company's claim that the inquiry cannot continue after repeal, the company's claim is invalid. The repeal will not affect any remedy, inquiry, or litigation which was initiated before the repeal. Okay, so these were the 3 points testing you on 3 different parts of repeal discussion. Then comes question number 15, residential status FEMA, guys. Mr. Raj, an Indian citizen, lived in India for 200 days during 23-24. On 1st April 24, he left for Singapore with an employment contract for 5 years. So guys, he's leaving India. On 1st April 24, he's leaving India for those 3 purposes, right? He's leaving India for employment outside India, or for business outside India, or for any other purpose indicating uncertain period. So because he's leaving India for those 3 purposes, I don't care about the 182 days criteria. When he's leaving India, he will become a PROI. Then during the same year, in July 24, he remitted funds from his Singapore salary account to invest in a Nidhi company. Tell me, he's a PROI. Can he invest in a Nidhi company? Guys, you've learned this. Investing in Nidhi company, investing in chit fund company, agriculture or plantation activities, then your real estate business, transferable development rights, prohibited transaction. Which category? Current account or capital account? Try to recall. This is a capital account transaction. This is a prohibited capital account transaction. So this question is testing you on 2 things. Thing number 1, that because he is leaving India for one of those 3 purposes, he becomes a PROI. Now after becoming a PROI, he is trying to invest in a Nidhi company in India. This is going to be a prohibited capital account transaction, not allowed. Right, guys? And then comes the last question over here, interpretation of statutes. As per Hayden's rule, what are the 4 things that are to be considered for true and sure interpretation of all statutes in general? What are the 4 things that are to be considered for true and sure interpretation of all statutes in general as per Hayden's rule? In Hayden's rule, if you remember, 4 points we have learned. Those 4 things we have to consider whenever we are making interpretation of any statute. 4 things. Thing number 1, what was the law before making the act? What was the old rule? Then what was the mischief or defect or hardship caused by the earlier law? Then how does the parliament seek to resolve or cure the mischief or deficiency? And lastly, what is the reason for the remedy? Very simple. Point number 1, what was the old law? What was the law before this new act was made? Then point number 2, in this old law, what was the problem? What was the defect? What was the mischief in this old law? Then point number 3, what is the how does the parliament seek to resolve the mischief? What is the remedy? How are they going to resolve this defect? How are they going to resolve this mischief? And point number 4, what is the reason for this remedy? So these are the 4 points which we should consider whenever we are interpreting any law. Nothing but the Hayden's rule, guys, which is also called as a mischief rule, right? 4 things. Number 1, what was the law before making the act? Number 2, what was the defect or hardship or the mischief in that earlier law? Then point number 3, how does the parliament seek to resolve or cure the mischief or the hardship? And lastly, what is the reason for the remedy? Okay, 4 important things which as per the Hayden's rule should be considered while interpreting any statute. Alright, so these were your descriptive questions in the 3rd test. Now come on, let's go to the MCQs one by one. Look at the MCQ, look at the first case study. Here we have 1, 2, 3, 3 case-based questions. Yeah, 3 of them. Let's see them one by one. Let's look at the first case study, LLP based question, guys. Let me zoom it a little for you. 1 minute. Look at this now. When Silver Line LLP was being set up in Delhi, its partners were excited to get started. LLP deed listed three partners: Blue Ocean LLP, another LLP from India, Sunshine Cooperative Society, and Mr. Arjun, a young entrepreneur. The registrar of LLP raised no initial objection and the incorporation certificate was issued. So, this LLP is having three partners, guys: Blue Ocean LLP, another LLP, then Sunshine Cooperative Society, and Mr. Arjun, a young entrepreneur. See, can an LLP be a partner of another LLP? Yes. Can an individual be a partner of an LLP? Yes. But can a cooperative society be a partner in another LLP? No, guys. A cooperative society, a sole proprietary concern, a corporation sole, they cannot be appointed as partners in an LLP. So here itself there is a violation. A cooperative society cannot be a partner in an LLP. There's a violation. However, trouble started almost immediately. Old businessmen in Mumbai who had run a traditional partnership firm called Silver Line and Company for 20 years objected furiously. They argued that the new LLP could not be registered with the same name as their firm and demanded a name change. The new partners, however, proudly displayed their certificate of registration and laughed off the protest. See, the LLP's name happens to be very similar to the name of another partnership firm. So, for this reason, can we ask the LLP to change the name? No. The law says LLP's name should not be identical or it should not closely resemble the name of another LLP, the name of another company, or the name of another registered trademark. But it can resemble the name of another partnership firm, no problem in that. Then the question says the partners debated where to run the operations. Although the registered office was in Delhi, Blue Ocean LLP suggested setting up a branch office in Singapore to expand into Southeast Asian market. Some members argued that LLP law restricts them to Indian soil, while others believed an international branch was possible. It's an LLP. LLP is incorporated in India. It can set up a branch office in Singapore, no problem in that. Then the question says, as their first financial year ended, Silver Line LLP's finance team ran into compliance trouble. Believing LLPs were like companies, they assumed that annual return must be filed within 60 days of holding an AGM. Since LLPs don't actually hold AGMs, they kept postponing the filing and ended up missing the statutory deadline. Notices of default began arriving from the registrar. So basically, the LLP has not filed the annual return on time. Now, there are how many questions? There are 4 questions under this. The first question: which of the 3 partners listed in Silver Line LLP are valid under the LLP Act? Which partners are valid? Except cooperative society. Other 2 are valid, guys. All 3 are valid? No. Only Blue Ocean LLP and Mr. Arjun, not Sunshine Cooperative Society. Option B. Cooperative society cannot be a partner of an LLP. Then comes the second question. The Mumbai firm Silver Line and Company objected to Silver Line LLP being incorporated with the identical name. Which statement correctly reflects the law? Name of LLP can be similar to the name of another LLP. The name of LLP can be similar to the name of another firm, guys. No problem. There's no violation over here. LLP cannot be incorporated with a name identical to any existing entity, whether company, LLP or firm. Wrong. LLP is free to have the same name as a traditional partnership firm, since a restriction on identical name applies only vis-a-vis companies and LLPs, not firms under the Partnership Act. Correct, guys. It can be similar to the name of another firm. No problem in that. Then comes the third question. Regarding offices, which statement is correct for Silver Line LLP? An LLP must have both registered office and branch office only in India. No, not necessary. LLP can have foreign offices only with RBI approval. No, not necessary. An LLP may have registered office abroad if approved by all partners. No, LLP's registered office has to be in India only. If registered office is abroad, it will become a foreign LLP. So LLP may have RO abroad if approved by all partners is wrong. RO has to be in India only. Only branch offices can be outside India. LLP must have RO in India but may have branches abroad. Option D. The branches may be abroad but RO has to be in India. Then comes a fourth question about filing annual return. Which timeline applies to LLP? It must be filed within 60 days from end of the financial year, irrespective of whether an AGM is held. So in an LLP, the time limit to file the annual return is 60 days, 60 days from the end of the financial year. Same time limit you have for foreign companies also, guys. Even for foreign companies, annual return has to be filed with the ROC within 60 days of the end of the financial year. Even over here as well, even for LLPs also, the annual return has to be filed within 60 days from the end of the financial year. So option A. Okay, so this was your first MCQ relating to LLP. Now come to the second case based MCQ. This is regarding General Clauses Act. Let's read the question. The question says Greenfield Development Authority was established under a special state law to regulate housing projects. Several disputes soon arose, raising doubts about how the General Clauses Act applies. First, the authority acquired large tracts of land from farmers. One farmer argued that land is not immovable property under the Act, since the authority was also taking over the trees, standing crops, and even machinery fixed on the land. Authority claimed all of this falls within immovable property. See, is land immovable property? Land is of course immovable property. So one farmer argued that land is not an immovable property. This argument is not right. Land, benefits arising out of land, things attached to the earth, things permanently fastened to anything attached to the earth, all of this is immovable property. So the farmer's argument is wrong. Later, when issuing show cause notices, authority served them in both printed form and as scanned PDFs sent by email. A group of developers challenged the notices, saying that email PDF cannot be considered as document. Even this is wrong. Under General Clauses Act, document includes both. It can be written on paper. It can also be email, guys. It can also be a PDF. It can also be a soft copy. So even a PDF also is going to be considered as a document. So even this argument is wrong. Finally, the state government appointed Mr. Rao as a chairman of Greenfield Authority for a term of 5 years. After just 2 years, due to allegations of misconduct, government passed an order removing him. So first the government appointed him and then the government removed him. Mr. Rao challenged the order, arguing that since the law only gave power to appoint, it did not empower the government to remove. Wrong. The authority who has the power to appoint also automatically has the power to remove also. So even this argument is wrong. Have a look at the questions now. Regarding the acquisition of land, standing crops, and attached machinery, what is the correct legal position under the General Clauses Act? Option A says only the land is treated as immovable property. Crops and machinery are excluded. See, even crops will be considered as immovable property, guys. What about machinery? See, the question over here says machinery is fixed on the land. Machinery fixed on the land, that is anything permanently fastened to the earth, even this will be considered as immovable property. So this statement is wrong. Machinery, even if permanently embedded in the earth, is excluded from immovable property. Wrong. If it is permanently fastened to the earth, it will be considered as immovable property. Option B is also wrong. Then land, benefits arising out of land, things attached to the earth like trees or machinery embedded, are all included in immovable property. Correct. Land, benefits arising out of land like standing crops in our example, things attached to the earth, things permanently fastened to anything attached to the earth like machinery in this example, they will all be considered as immovable property. So option C. Then comes question 6. The developer's objection that PDF notices by email are not documents must be examined. What is the correct position? Even PDF notices by email are documents, guys. So document refers only to physical papers. Electronic records are excluded. No. Document includes any matter expressed or described upon any substance, including electronic records such as email PDFs. So the notices are valid. Correct. Option B. Document under the Act refers only to official government records. No. Only documents signed with physical ink signatures are recognized. PDFs without wet signatures are invalid. Wrong. Option B, guys. So basically, the definition of document, if you remember, in General Clauses Act, we had learned that document includes any matter written, expressed or described upon any substance using letters, figures or marks to be used for recording that matter. So it can be on any substance. It is not necessary it has to be on paper. It can also be a soft copy. Even that will be considered as document. So option B. Then comes question number 7. On the removal of Mr. Rao, what is the correct interpretation? Remember, the state government appointed Mr. Rao. So the person who appoints you also automatically automatically has a power to remove you. Since the statute only provides a power to appoint, government cannot remove or dismiss, wrong guys, unless expressly stated. Power to appoint does not carry with it the power to remove or suspend. No. Under the General Clauses Act, the power to appoint includes the power to suspend or dismiss unless the law expressly provides otherwise. Option C. If any party has the power to appoint, then that party will also automatically have the power to suspend or dismiss. This is going to be option C over here. Okay, then come to the third case-based question from FEMA, guys, last MCQ. Overtech Limited, an Indian company in the infrastructure sector, decided to raise funds by issuing a series of debentures to overseas investors. To make the instruments attractive, the terms were drafted in a rather unusual way. Debentures are denominated in Indian rupees. The redemption amount, however, was agreed to be payable in dollars. So, which means be careful. The debentures are denominated in INR, but the redemption amount is going to be in dollars. For the first 3 years, interest 8% in Indian rupees. Next 2 years, interest 6% in dollars. So full khichdi only. Denominated in INR, redemption in dollars. First 3 years, interest is in INR. Next 2 years, interest is in dollars. Is it foreign security or not? Come on, try to recall. Foreign security means, first of all, it has to be expressed in foreign currency. It has to be denominated in foreign currency. Whether the redemption and the interest are in Indian currency or foreign currency, that is secondary. But first of all, the primary point in our foreign security discussion is that these securities should be denominated in foreign currency. But they are denominated in INR. So here itself we can conclude that they are not foreign security. See, in foreign securities, whether the redemption and the income, whether the redemption and the return, whether they are in foreign currency or Indian currency, that doesn't matter. But they must be expressed in foreign currency. They must be denominated in foreign currency. Because it is denominated in Indian rupees, these debentures are not foreign securities. So they are not foreign securities because they are denominated in INR. Yes, guys, they are foreign securities is wrong. They are not foreign securities unless both face value and redemption are denominated in foreign currency. No. If they are denominated in foreign currency, even if the redemption is in INR, it will still be foreign security. So it is not necessary that redemption amount has to be in foreign currency. It is not necessary. Only thing is it should be denominated in foreign currency. So it's not option C also. Then they are partly foreign securities and partly Indian securities. No, they are not foreign securities. They will be considered as foreign securities only if they are denominated in foreign currency. Because they're denominated in INR, they will not be considered as foreign securities. Okay, so this was your third test, your test covering the other laws and LLP Act. Okay, now after this we'll take up the fourth test, which is the last test, wherein we will be taking up the entire syllabus. It's going to be a proper 100 marks test question paper in the same pattern in which ICAI makes the question papers. In that same pattern, we have the fourth test that we'll take up after this. So starting off with the fourth test now, guys, even over here, same thing. We'll straight away go to the descriptive questions first. This will be slightly lengthy because it's going to be a 100 marks test, right? So come on, let's have a look at the first question right here relating to prospectus. So the question says, Bright Future Technologies Limited is a fast-growing public company in the renewable energy sector, decided to raise funds through public issue of shares. So the company wants to do a public issue, okay. For its first issue, company filed a prospectus with the registrar that did not contain complete details about the price of securities and the quantum of issue. What will you call this prospectus? What will you call a prospectus which does not have complete information about the price of the securities and the quantum of securities? You will call this as a red herring prospectus, guys, right? The management explained to the investors that this was a draft document used at the stage of book building and that the final details would be filed before the actual allotment of securities. Clearly a red herring prospectus. In red herring prospectus answer, we do talk about book building also, right? That this is a prospectus that we use whenever we use book building while making a public offer. Clearly, it's a red herring prospectus. Encouraged by the success of its first issue, company planned to make multiple issues of non-convertible debentures over the next year. So the first issue was an issue of shares. First issue was a public issue of shares. Then, encouraged by the success of the first issue, company planned to make multiple issues of non-convertible debentures. So different transaction altogether. Till here, they're talking about red herring prospectus. Then now they're saying that they're going to make multiple issues of non-convertible debentures over the next year. To avoid the hassle of preparing a fresh prospectus for each issue, the board decided to file a single prospectus that would serve as base document for all the issues to be made within a certain period. What will you call this prospectus, guys? One single prospectus a company is issuing that will serve as a base document for all issues to be made within a certain period, which means this prospectus will have a validity of a certain period. It will have a shelf life. What will you call such prospectus? You will call them as shelf prospectus, guys. Right? So the first issue when the company is making a public offer, this is a red herring prospectus. And for subsequent issues when the company is issuing one prospectus, same prospectus will be common for all subsequent issues which are made in a certain validity period. This prospectus will become a shelf prospectus. So identify the type of each prospectus filed by Bright Future. The first one is red herring prospectus, second one is shelf prospectus, and state the key provisions that the company should keep in mind for the prospectus relating to multiple issues of non-convertible debentures. So key provisions are being asked only for the second one. Second one, multiple issues, we are using a shelf prospectus. So shelf prospectus, what are the key features? Number one, shelf prospectus is a prospectus which has a shelf life of 1 year. In this 1 year, you can make any number of issues. Again and again, prospectus is not required. Without the issue of further prospectus, you can make any number of issues in this validity period of 1 year. But every time in this 1 year validity period, whenever you make an issue, you do have to prepare one document called as information memorandum. Like for example, let us say the shelf prospectus was issued on the 1st of January 2025. Now this shelf prospectus will have validity period for 1 year, guys. So therefore till 31st December 2025, this shelf prospectus will have validity period. Now let us say in between, in the month of June, the company makes another issue. So again the company need not make a prospectus. The same shelf prospectus which the company had issued on 1st Jan, that itself will be valid. But the company will have to prepare one information memorandum. This information memorandum will contain details about what are the changes which have happened in the company since 1st Jan 25. Since the shelf prospectus, since then, what are the changes that have happened in the company? Are any new charges created? Is there any change in the financial position of the company? Any other change? So basically, since the shelf prospectus was issued, since then till June, whatever are the changes which have happened in the company, all those changes we will put in one document. The document is called as information memorandum. So for all subsequent issues, like for this June issue, prospectus will be equal to shelf prospectus plus information memorandum. Right, guys? For all subsequent issues, the information memorandum along with the shelf prospectus put together, these two documents put together will be deemed to be the prospectus. This information memorandum also has to be filed with the ROC within 1 month before the issue of the subsequent offer. And remember one very important thing, that yes, we do say that the shelf prospectus has a validity period of 1 year. We do say, right, that the shelf prospectus has a validity period of 1 year. In 1 year, we can make any number of issues. But 1 year from when, be careful, they can ask a question on that. 1 year from the date of opening of the first offer. 1 year from when? 1 year from the date of opening of the first offer. Okay. So that is it about this question, guys. They first asked us to identify the two types of prospectus. This first one over here was red herring prospectus, and the second one was shelf prospectus, because one single prospectus was being used for multiple issues. Then they asked us the key provisions of the second one. So key provisions of the second one, I spoke to you about all of them one by one. Here there's a hidden MCQ point which you should be careful. Shelf prospectus, yes, it has a validity period of 1 year, but 1 year from when? 1 year from the date of opening of the first offer. Okay, now come to the second subdivision, subdivision B. This is from your management and administration chapter. Sun Glow Limited, a listed public company, convened its AGM on 30th September 24. Company provided its members facility of e-voting. Okay, e-voting, guys. So section 108 will apply. Then the question says, Mr. A shareholder, had already cast his vote electronically before the meeting. However, on the day of the AGM, he appeared in person and demanded to vote again. Is that allowed? No. See, if you have already voted electronically, yes, you can come for the meeting. You are allowed to attend the meeting. You can attend the meeting, but you cannot vote again at the meeting. That will not be allowed. he demanded to vote again, arguing that since he was physically present, he should not be deprived of exercising his rights at the meeting. No, Mr. A, you are clearly wrong. The chairman refused to permit him to vote again, though he allowed Mr. A to attend the meeting. Yes, that member who has already voted electronically, yes, he can attend the meeting, but he can't vote again at the meeting. Then, meanwhile, some other shareholders complained that the e-voting window had been closed at 5 p.m. on 20th September 24, which they alleged curtailed their right to vote until the very start of the meeting. See, what does the provision say? The meeting is going to be held on 30th September 24, right? So the provision says that the e-voting facility has to be closed on the preceding day 5 p.m. So preceding day will be 29 September 24, guys. So 29 September 24 at 5 p.m. they should have closed the e-voting facility. But the question says that they closed the e-voting facility on 20th September 24 at 5 p.m. So clearly there is a violation. They should have closed only on 29 September 24 at 5 p.m. So this is wrong. Then after the meeting concluded, the scrutinizer appointed by the board issued two separate reports, one for remote e-voting and another for poll conducted at the meeting, and forwarded both to the chairman. See, listen, to understand this para, you have to understand one basic background point, which I'm hoping you already are aware of, but let me give you one quick revision. See, in section 108 in e-voting, what is the whole process? First, the members are allowed to vote from home electronically, guys. Then after that, one meeting also is conducted. Why? Members who were not able to vote electronically from home, they can come to the meeting and they can vote at the meeting. So which means, do you agree, in section 108 there will be two situations or two stages of voting. One will be members will be voting from home electronically using internet, and number two, those members who are not able to vote electronically, they will be voting at the meeting. So voting will happen in two stages. Okay. Now the scrutinizer is supposed to prepare one single report, guys. One consolidated scrutinizer's report he is supposed to prepare. That one report itself will contain total how many votes were cast in favor, total how many votes were cast against. So the votes which were cast in the meeting plus votes which are already cast electronically, both put together he will prepare one consolidated scrutinizer report and he will give it to the chairperson. But here the scrutinizer has prepared two separate reports, which is again a violation of the law. Board now seeks your legal advice. Examine each of the actions of the chairman, the company and the scrutinizer. Are they in compliance with the Companies Act? So one by one, if we see, from the beginning, if we see the very first point, the company is a listed company, guys. Yes, so every listed company and every company which has at least 1,000 members is mandatorily supposed to provide e-voting facility. Now here the company is a listed company, so yes, it has to provide e-voting facility. Correctly, the company has given e-voting facility, so there is no violation over there. Understanding point number one is clear, that which companies have to provide e-voting facility. Number one, all listed companies, and number two, all those companies which have at least 1,000 members. Okay. Then comes the second point, Mr. A. Now this Mr. A, he has already voted electronically. So can he vote again at the meeting? We've already decided, we've already spoken about this. Because he has already voted electronically, yes, he can attend the meeting, but he cannot vote again at the meeting. So what did the chairperson do in this situation? The chairperson refused to permit him to vote again, though he allowed Mr. A to attend the meeting. So what the chairperson has done over here is perfect, guys. The chairperson complied with the provisions of the Companies Act. Alright, then comes the next point, the third point, the closing of the e-voting facility. We were supposed to close on the preceding day at 5 p.m. That is, we were supposed to close the e-voting facility on 29 September at 5 p.m. But the company closed on 28 September itself, which means the company has clearly not complied with the provisions in this regard also. And the last point is about the scrutinizers, guys. Even this I've told you already. The scrutinizer has to prepare one consolidated report. That consolidated report will contain the total number of votes which are cast in the meeting plus electronic voting, both put together. One consolidated report he is supposed to prepare and give that report to the chairperson within 3 days after the conclusion of the meeting. So here, however, in this question, the scrutinizer has prepared two separate reports, right? Which means clearly he has not complied with the provisions of the Companies Act. So through this question, guys, there were various points. We had to just mention about each of the points, whether there is a compliance or there is a non-compliance. So I think good provisions relating to 108, nicely the provisions got revised for you. Now come to the third subdivision, guys. This is relating to FEMA. The question says, TransGlobe Inc., a US-based multinational, has established multiple business units in different countries. It set up a software development center in Bangalore, India, to support its global operations. The center is fully controlled by the US head office, though all its employees are based in India. So, number one, it has a software development center in Bangalore. Then this Bangalore unit later opened a branch in Dubai, which is monitored and managed directly by the Bangalore branch. Then an Indian company, Brighttech Limited, has opened a representative office in London for liaising with its European customers. The management of Transglobe Inc. is confused about how FEMA defines residential status for such establishments and has sought advice on the residential status of the above described establishments. So this is a residential status FEMA question, guys, but you might find it a little different because this is not residential status of individuals. This is residential status of non-individuals covering branches, offices and agencies and all. So I'll help you understand. Point number one, we have Transglobe Inc. guys. Now this is a US based multinational incorporated outside India. So if a company is incorporated outside India, this will become a person resident outside India. Point number one. Okay. If it's a company incorporated outside India, it will become PROI. Now, this PROI, this Transglobe Inc. has a Bangalore office. So basically, it has a BOA in India, guys. If you have watched my FEMA revision video, which I've already uploaded on YouTube, I would have taught you over there that if you have a BOA in India, okay, I have explained this concept very nicely in that video. If the BOA happens to be in India, doesn't matter who owns it, doesn't matter who controls it. If the BOA is in India, then that BOA will become PRI. So the Bangalore office will become PRI. Then the branch in Dubai, this is outside India. But however, it is managed by the Bangalore office. It is managed by a PRI. So even if the BOA is situated outside India, but if the BOA is being managed by a PRI, then even though it is outside India, even this will become a PRI. Understanding? So point number one, Transglobe Inc. because it is a company incorporated outside India, it is a PROI. Then the Bangalore office, because it is in India, it becomes a PRI. Then the Dubai branch, even though it is outside India, because it is owned, controlled by a PRI, for that reason, even this becomes a PRI. Lastly, representative office. Meanwhile, this representative office of this Indian company, an Indian company, Brighttech Limited, because it's an Indian company, because it is incorporated in India, Brighttech Limited will be a PRI. It has opened a representative office in London. So it has an office outside India, it has an office in London, but because this office is owned and controlled by whom? By this Brighttech Limited, which is a PRI. So that is why even this representative office in London will also become a PRI. Understanding? It's in London. It is outside India. No doubt it is outside India. It is not in India. It's in London. But however, because it is owned or controlled by an Indian company, because it is owned or controlled by a PRI, because of that reason, this representative office will also become a PRI. Understanding? So simple words, guys. If the BOA happens to be in India, doesn't matter who owns it, doesn't matter who controls it, it is a PRI. Okay. If the BOA happens to be outside India, but if it is owned or controlled by a PRI, then also it will become a PRI even if it is outside India. Okay, this is it about your first question, all the three subdivisions we have discussed. Now come to the second question, guys, over here. Here, this is about Section 8 company. The question says, Green Future Foundation, a Section 8 company registered in Chennai, was granted a license in 2021 to promote environmental awareness and sustainable development. In 2024, during an inspection, the RD found several irregularities. Company diverted part of its funds to finance a private real estate venture promoted by directors, which was clearly outside its charitable objects. So the company is violating its objects, guys. It's a Section 8 company. The company is clearly violating its objects. It is using its money for non-charitable objects. It's violating its objects. Then, investigations revealed that false records were maintained, giving an impression that CSR contributions from corporates were being used for afforestation projects, whereas in reality, a portion was siphoned off. So, there is fraud happening in the company. They are showing as if they are using the money for afforestation, but in reality, they are siphoning off the money, they are taking off the money for personal purposes. Then, several complaints alleged that companies' activities were prejudicial to public interest since local communities were denied promised benefits. The regional director issued a notice to Green Future Foundation of its intention to revoke the license and gave an opportunity of being heard. Despite the company's defense, the authority proceeded to revoke the license. Directors are now confused and want clarity on under what grounds the license of Section 8 company can be revoked. What are the grounds for revocation of license? Is the RD justified in revoking the license? So tell me, what are the grounds? When does a Section 8 company's license get revoked? See, when the Section 8 company's license was issued, okay, that time the license will be issued subject to some terms and conditions. So if the Section 8 company contravenes the terms and conditions subject to which the license was issued, then in that case, the Section 8 company's license will get revoked. Number 2, if the Section 8 company is conducting its affairs in a fraudulent manner, or if it is violating its objects, or if it is doing anything which is against public interest, then also the license will be revoked. So first thing they asked us was, what are the grounds under which the license of Section 8 company will be revoked? There are 2 grounds, majorly 2 grounds. You can also split it as 4 grounds, up to you. Number 1, when the Section 8 company contravenes the conditions subject to which the license was issued. Number 2, if the Section 8 company is conducting its affairs fraudulently. Number 3, when the Section 8 company is violating its objects. And number 4, if it is conducting its affairs in a prejudicial manner, which is prejudicial to public interest. Okay. Then they asked us whether the regional director was justified in revoking the license. In this question, if you see, what are the grounds which are matching with this? See, there are 2 things which are matching over here. Number 1, the company is using the money, the company is using its funds for non-charitable activities, guys. So the company is violating its objects. So this is the first reason because of which the revocation of license is valid over here. And secondly, the company is clearly doing fraud over here. The company is trying to give an impression that the company is using the money for afforestation, whereas in reality the money is being siphoned off. So the company is conducting its affairs in a fraudulent manner. So even this is a ground for revocation. And number 3, the company is doing activities over here which are prejudicial to public interest. So this is also a reason over here. So there are 3 reasons, and because of these 3 reasons, the RD's decision to revoke the license, is it justified? Yes, it is perfectly justified. Okay. Then the next question says, thereafter the central government ordered winding up of the company. How should the assets remaining after satisfaction of liabilities be dealt with? See, what will you do with the leftover assets of a Section 8 company? See, in case a Section 8 company, come to this part now. In case a Section 8 company is being wound up, let's say the license is being revoked, and after the license is being revoked, either the Section 8 company can be converted into a public company or a private company, or it can be merged with another Section 8 company, or it can simply be wound up. Here they are winding up the Section 8 company. So if they are winding up the Section 8 company, whatever are the surplus assets left after the whole liquidation process is over, whatever surplus assets are left, what to do with the surplus assets? In a Section 8 company, it is prohibited to make any distribution to the shareholders. So the surplus assets can't be distributed to the shareholders. Only 2 options. Either we will transfer those surplus assets to some other Section 8 company having similar objects, or we will simply sell away the surplus assets, and whatever proceeds we get, we will credit the proceeds to Insolvency and Bankruptcy Fund under Insolvency and Bankruptcy Code 2016. Okay, let me summarize the whole question for you. First of all, what are the grounds for revocation of license, guys? There are totally 4 grounds. Number 1, if the company is contravening the terms and conditions subject to which the license was issued. Then number 2, in case the company happens to conduct its affairs in a fraudulent manner. Then number 3, if the company is conducting its affairs which are against its objects, basically the company is violating its objects. Then number 3, if the company is doing anything which is going to be prejudicial to public interest. So if any of these situations arise, then the license of the Section 8 company will get revoked. Okay. In this question, these 3 situations were applicable, and that is why the revocation of license by RD was perfectly justified in this question. Okay. Then once a license is revoked, what will happen to the Section 8 company? Either it will get converted into a public company or a private company, or it will get merged with some other Section 8 company, or it will get wound up. Here the order is being passed to wind up the company. So if the Section 8 company's license is revoked, and thereafter if an order is being passed to wind up the company, then in that case, in case there are any surplus assets, what to do with the surplus assets? Generally, if you see in any other company, if there are surplus assets, they will distribute the surplus assets to the shareholders, guys. But in a Section 8 company, if they have surplus assets, they can't distribute to the shareholders. The surplus assets have to be donated to some other Section 8 company having similar objects, or the company can sell away the surplus assets and get money. And that money they can simply donate to Insolvency Bankruptcy Fund under the Insolvency Bankruptcy Code 2016. Now understanding everybody? Yes, so this was your entire discussion with respect to revocation of license, section 8 companies. Okay, now come to the second subdivision here. The question says Skylink Aerospace Limited, a company incorporated in US. So the company is incorporated outside India. It is engaged in supplying aviation technology to India. It has opened a branch office in Bangalore for R&D and a liaison office in Hyderabad. So guys, condition number 1, yes, his company is incorporated outside India. Condition 2, yes, his company does have a place of business in India. It has a branch office in Bangalore. It has a liaison office in Hyderabad. So condition 2 is also fulfilled. And it is carrying on business activity in India, guys. It is supplying aviation technology in India. So yes, this company does become a foreign company. Point number 1. Company's paid up share capital is held as follows. 30% is held by American parent promoters, 25% is held by Arjun and Kavya, both are Indian citizens residing abroad, non-residents under FEMA. 30% is held by Technova India Private Limited, which is an Indian company. 15% is held by Consortium of Foreign Venture Capital Investors. The board of Skylink seeks your advice on the following. Whether Skylink Aerospace Limited is a foreign company? Yes, it is a foreign company because it is incorporated outside India. Condition 1 is fulfilled. And your 2 additional conditions are also fulfilled. It does have a place of business in India and it is carrying on business activity in India. Hence, yes, it is a foreign company. To what extent Companies Act will apply to Skylink's Indian business? To what extent will the Companies Act apply? Because it is a foreign company, because of that reason, Chapter 22 provisions will anyways apply, guys. That is, Section 380 to Section 393 will anyways apply because it's a foreign company. In addition to that, it is a foreign company, condition number 1. Condition number 2, at least 50%, that is 55% of its capital is being held by Indian citizens or Indian companies put together. And that is understanding at least 50%, at least 50% of equity shares, preference shares, whatever put together is being held by Indian citizens and Indian companies, and therefore it will be deemed to be an Indian company to the extent of its Indian operations, whatever it is its Indian business, to that extent it will be deemed to be an Indian company, and the whole Companies Act will apply as if it's an Indian company but on its Indian business. Right, guys? Basically, it becomes a Section 379 subsection 2 company. So, first of all, is it a foreign company? Yes, clearly it is a foreign company. Then they asked us to what extent Companies Act 2013 will apply to this company. So, because it is a foreign company, Chapter 22 will anyways apply. Section 380 to Section 393 will anyways apply because it's a foreign company. In addition to that, over and above that, because it is a Section 379 subsection 2 company, because of that reason, the whole of Companies Act will apply on its Indian business as if it is an Indian company, deemed to be an Indian company. Alright, guys, this was a question solely focusing on companies incorporated outside India. Now come on, let's move on. Let's come to the next question. Now this one is subdivision C of your second question. Under the Clean Air Regulation Act 2020, Pollution Control Authority was conferred with the power to issue directions to industries to install pollution control equipment. So we have some regulation which has given power to the Pollution Control Authority. What power? Power to issue directions. In Jan 2022, the authority exercised this power by directing Blue Sky Chemicals Limited to install air filters in its factory. The company complied. Perfect, guys. So this particular regulations has given authority they've given power to this authority to issue directions, and exercising that power, this authority has issued directions to this particular company, direction to install air filters. Okay. In August 2023, during fresh inspection, the authority again issued a direction requiring Blue Sky Chemicals Limited to upgrade its filters to a newer technology. Company refused, arguing that once the authority had exercised the power in 2022, the same power cannot be exercised again in 2023 against the same company. The Act does not explicitly mention that the power can be used more than once. Examine whether the authority is legally entitled to issue such repeated directions. Support your answer with reference to the General Clauses Act. Very, very important, guys. Listen to me. See, this is one small tiny point covered in General Clauses Act. The law says that if any central act or regulation confers any power then that power may be exercised from time to time as and when the occasion requires. See, if the law has given an authority some power, let's say in our example over here, in our question over here, the power to issue directions, that doesn't mean that the power can be exercised only once. No, the power can be exercised from time to time. From time to time means whenever the occasion arises, whenever the occasion requires, whenever it is required, any number of times, again and again, that power can be exercised. It does not mean the power is only one time power, no. So in this question, this pollution control authority already exercised power in 2022. That time the company complied with the direction. Then again, when this authority gave direction once again in 2023, the company is saying that no, you have already exercised power in 2022. How many times will you exercise power against me? This argument is wrong. If the authority has the power to issue directions, it can issue directions from time to time as and when the occasion arises. They can keep issuing directions. It is not a one time. It is not a one time exercise, guys. They can exercise this power from time to time. Whenever the situation arises, they can exercise this power. Then the act does not explicitly mention that power can be used more than once. It is not required for the act to mention that the power can be exercised how many times. If the law says that a particular authority has a power, then that authority can exercise that power from time to time as and when the occasion arises. It is not a one-time exercise. The Pollution Control Authority is legally entitled to issue repeated directions to Blue Sky Chemicals. Perfectly valid. Understanding? Yes, guys, look at this. The contention is incorrect. As a new inspection in 2023 revealed the need for upgraded filters, authority was within its right to issue another direction. It is not a one-time power. They can exercise this power as many times as they want. It is not one-time exercise of power. Okay. Then come to the third question, subdivision A. Apex Infra Limited raised funds in the following ways. It issued commercial papers in accordance with RBI guidelines to institutional investors. Then it accepted 10 crore rupees as share application money from prospective investors on 1st February 25. Shares were not allotted on time. Company refunded the money on 25th April 25. In respect of a share application from Mr. Amit, instead of refunding, company adjusted the money towards repayment of old loans and receivables. Extremely important, guys, listen to me. Whether the amounts raised under one would be treated as deposit. Any money if the company raises against issue of commercial paper is not a deposit, guys. That point everybody will be knowing very well. Any money if the company has raised against issue of commercial paper, it is not considered as deposit. This point is simple. The most important and the most interesting point over here is about share application money. Whether the treatment of share application money under subdivision 2 is legally valid, from what point of time it would be regarded as deposit, if at all. See, listen to me. For share application money, what is the timeline? See, once a company receives the share application money, from the date of receipt, within 60 days, the company is supposed to allot the securities, guys. Because of some reason, if the company is not able to allot within 60 days, then the company is supposed to refund the money within the next 15 days, guys. If the company does this correctly, then it will not be considered as deposit. If the company does not refund the money within these 15 days also, then thereafter it will be considered as if it is a deposit. That is 76th day onwards, it will you will start considering it as deposit till 75 days. How 75 days? First, we will give the company 60 days time to allot the securities. If the company is unable to allot, we will give the company next 15 days time to refund the money. So total 75 days. Till 75th day, it will not be considered as deposit. If the company does not refund the money even upon expiry of the 75th day, then 76th day onwards only we start considering it as deposit. Okay. Then there's one more point involved over here. The question says, in respect of share application from Mr. Amit, instead of refunding, the company adjusted the money towards repayment of old loans and receivables. This is not allowed, guys. This will not be considered as refund. Basically, the law very clearly says that when we talk about refund, within next 15 days, when we say refund, company should actually return the money. Company should actually refund the money. If the company is simply adjusting the refund against any receivable from the other party, then it will not be considered as refund, guys. Refund means company actually has to repay the money. Company can't do any adjustment and all and call it refund. Over here, instead of refunding the money to Mr. Amit, the company is adjusting the money against repayment of old loans and receivables. Sorry, not allowed. This will not be considered as refund. Okay, guys. Then let's also talk about the dates over here. So when did the company receive the share application money? 1st February 25. So 1st February 2025. Let me do it for you over here. 1st February 2025, from this date, within 60 days, the company is supposed to allot the securities. See, in the month of February itself, you will have 27 days more. So after 1st February, total 28 days. So 28 minus 1, 27 days in February, 31 days in March. So here itself, you have 58 days. So you need 2 more days, 60 days, no, 2 more days. So 2nd of April 2025, this is what your 60 days time limit would be. And if the company is unable to allot by 2nd April, company is supposed to refund the money within the next 15 days. That is, by 17th of April 2025, the company is supposed to refund the money. But here in this question, the company did not the company refunded only on 25th April. So which means there is a delay. So they are asking us whether they are asking us from what date onwards it will be considered as deposit. It will be considered as deposit from the 76th day onwards. That is, from 18th April 2024 onwards, it will be considered as deposit. Understanding, guys? See, the company received the share application money, then within 60 days, that is by 2nd April 24, company should have allotted the securities. Company did not allot. So within the next 15 days, that is by 17th April, company should have refunded the money. The company did not refund on 17th April. Company is refunding only on 25th April. So which means company is not refunding on time. That is why next day onwards, that is 18th April 2024 onwards, we will start considering that money as deposit. Okay, and when it comes to Amit's money, I've already told you, we will treat as if the company has not even refunded the money to him, because simply adjusting the money, adjustment will not be treated as refund. For this purpose, when we say refund, the company should actually refund the money, company should actually repay the money. If the company simply makes an adjustment, it will not be treated as refund. Okay, so whether the amount raised under one was commercial paper, guys. Is commercial paper a deposit? No. Any money received against commercial paper is not a deposit. Then number 2, second thing they were asking us about the share application money. Share application money, yes, it will be considered as deposit. 18th April 24 onwards, it will be considered as deposit. And another special point was about this Amit. The company did not refund the money to him. Company simply adjusted the money. That adjustment will not be considered as refund. Okay. Then comes the next subdivision over here. The question says, Sun Globe Industries Limited, a public company, was recently incorporated. It set up its operations across multiple cities in India. The following issues were noticed by the ROC during inspection. It has been 2 months since incorporation. Company did not file verification of registered office, arguing that since the office was functional, no formal intimation was required. In August 24, company shifted its RO from Kochi in Kerala to Calicut in Kerala, but informed ROC in December 24, claiming that the delay was due to administrative reasons. Simple board resolution was passed to facilitate this change. Company did not comply with the applicable provisions of alteration of registered office clause of MOA. Despite shifting the registered office, company displayed its name outside its branch office only in English. ROC has now issued a show cause notice to Sun Globe Industries Limited. Examine whether the company has complied with the respective provisions of Companies Act 2013 in each of the above cases. Come on, guys. There are 4 points. We have to see whether there is any non-compliance or not. The first subdivision, it has been 2 months since incorporation. Company did not file verification of registered office. Come on, guys. Try to recall. Once a company is incorporated, within 30 days of incorporation, the company is supposed to file with the ROC verification of registered office. Section 10A, guys. Section 10A is extremely important concept. It's an extremely important section from your examination point of view. Be really careful about this. So in section 10A, there are 2 points. One is a declaration by the directors, a declaration saying that the subscribers have fully paid for the shares within 180 days, guys, that point. And the second point is this about verification of registered office address. The verification of registered office address has to be filed with the ROC within 30 days of incorporation. So here if you see, it has been 2 months. They have still not filed the verification of registered office. So is there a is there a non-compliance over here? Yes, there is clearly a non-compliance. Company within 30 days of incorporation itself, you should have filed verification of RO with the ROC. You did not file, hence there is clearly a non-compliance. Then comes the second subdivision. The company shifted its RO from Kochi in Kerala to Calicut in Kerala, which means the company is shifting its registered office outside the local limits of the city, town, or village, guys. Company is moving from one city to another city. Company staying within the same state, same ROC. Only thing is, company is moving from one city to another city. But if the company is moving the registered office, if the company is shifting the registered office outside the local limits of city, town, or village, section 12, guys, number 1, company will have to pass a special resolution, and number 2, company will have to inform the ROC about this within 30 days, right? So two problems over here. They simply passed a board resolution. Board resolution will not be enough over here. They will have to pass a special resolution. Problem number 1. Problem number 2, they informed ROC only in December 24. Shifting they did in August 24 itself. They are informing only in December 24. So second problem is they did not inform within 30 days of change. So even over here also clearly there is non-compliance. Clearly, right, guys? Then comes the third subdivision. Company did not comply with the applicable provisions of alteration of registered clause. Guys, is there an alteration of registered clause over here? No. Even earlier, the registered office was in Kerala. Even now, the registered office is in Kerala only. There is no... See, when do you say that there is an alteration of registered office clause? In the registered office clause, in the situation clause, in the domicile clause, what do you write? Do you write the whole RO address? No. You only write the name of the state where the RO is situated, guys. So, only Kerala you're supposed to write. Even earlier it was Kerala, even now it is Kerala. So is there any alteration in the registered clause of the MOA? There is no alteration over here. So there is the company has complied with the respective provisions in this regard. There is no change in the state in which RO is situated. There is no requirement to alter the RO clause itself. There is no requirement to alter the RO clause over here. It was Kerala. It is even now Kerala. There is no alteration required at all. So, company has not done any violation over here. Then comes the last point. Company is displaying its name outside branch offices only in English. That is wrong, guys. Why is that wrong? Because outside every place of business, company should put two things. Number 1, the company should put its name, and number 2, the company should put its registered office address outside every place of business. But this should be put in what language? It should definitely be put in the language which is most commonly used in that particular locality. In this question, they are saying that the company displayed its name outside the branch office only in English. It is wrong. You also have to put the name and the registered office address in the language of that particular locality also. Like for example, if the branch office is located in Chennai, then the name and the registered office address has to be put in Tamil also outside that branch office. So wherever the branch or whatever place of business is situated, in that particular locality, what language is being used most commonly, in that language also the name and the registered office address has to be put outside every place of business of the company. Okay, so there is a violation over here. So 4 points, guys. In the first 2 points there is a violation. Even in the last point there is a violation, but in the third point there is no violation because there is no situation clause alteration concept itself applicable, because the state stays the same. Right, guys? So this was your second question. Now come on, have a look at the next question over here. Write about the significance of explanations as an internal aid for interpretation. Any two objects of inserting an explanation. Straightforward theory question, guys. Interpretation of statutes. You can have a look at the answer over here straight away later. Now come to the fourth question. In the fourth question, we are going to totally focus on the dividends concept, guys. The question says, Blue Ocean Limited, a reputed public company, announced to the press that it would give its shareholders the most innovative reward in the corporate history for 23-24. When the matter came up in the board meeting, following dramatic proposals were made. 4 proposals were made. What are they asking us? Several shareholders, alarmed by these proposals, have objected and sent complaints to the registrar of companies. Examine whether each of the above proposals is legally valid or not. There are 4 proposals. We have to state whether each proposal is valid or not. Okay. So one director proudly suggested that instead of giving boring cash, the company should distribute gift hampers of premium products as dividend, claiming this will also promote the brand. Invalid. Terrible, guys. This is clearly invalid because dividend has to be paid in money. It has to be in cash. It can't be in kind. This is definitely invalid. Then, second proposal. Another director, eager to impress investors, proposed declaring dividend without providing for depreciation on the company's assets, insisting that shareholders care about cash in hand, not accounting entries. Even this is going to be invalid. Before the company declares dividend, the company has to provide for depreciation, because if depreciation is not provided, then the value of assets will be overstated, the profits will be overstated. So therefore, it is mandatory that whenever a company declares dividend, before declaring dividend, the company should first provide for depreciation. Only then the company is supposed to declare dividend. So here the company, without providing depreciation, it wants to declare dividend. Even this is invalid. Then comes the third proposal. Another director suggested that dividend should be paid at 20% of the paid up value of shares. The articles of association were silent, but he argued that it is common sense to calculate dividend on what shareholders have actually paid, not on face value. Even this is invalid, guys. Generally, dividend has to be a percentage of nominal value. It has to be a percentage of face value. Only if the AOA specifically mentions, only then dividend can be a percentage of paid up value. But here, the AOA is silent, the question is saying. So you can't pay dividend as a percentage of paid up value. By default, it has to be a percentage of face value only, nominal value only. Even this is invalid. Last point, the fourth point, finally another director suggested that company would declare dividend without transferring any amount to reserves, stating that transfer to reserves is just an old-fashioned ritual. This is valid. Transfer to reserves is not mandatory anymore. It's up to the company. It is totally at the discretion of the company. The company can decide whether they want to transfer profits to reserves or not. And if they decide to transfer, how much should they transfer to reserves? Everything we are leaving on the company to decide. It is not mandatory to transfer profits to the reserve before declaring dividend. It is not mandatory. So this is going to be a valid proposal, but the first 3 are invalid proposal. Okay. Then come to this next subdivision. State circumstances under which partner's interest shall cease under LLP Act. Nothing but cessation of partnership interest, guys. Just the situations they have asked us. Straightforward theory. Explain the statutory provision requiring LLP to notify the ROC about cessation. Discuss legal significance in relation to validity and effectiveness of cessation. So first they have asked us what are the situations in which the partnership interest will cease. Then, very important point, cessation will be effective only after we have informed the ROC about it. Only then cessation will be effective. So either the LLP itself should inform the ROC within 30 days, or if the LLP is not informing ROC, then in that case a partner who is leaving the LLP, he itself can inform the ROC. In that case, ROC will obtain confirmation from LLP within 15 days. So either the LLP itself has to inform ROC about cessation within 30 days. If LLP is not informing, then the partner who is ceasing to be a partner, that partner he himself can inform ROC. But in that case, ROC will ask for confirmation from LLP within 15 days. Why is all this important? This is important because cessation of partnership interest will be effective only after informing the ROC about it. That is why informing ROC, the time limits, the process, the whole concept regarding informing ROC about cessation is really, really important, because only when we inform ROC, only then cessation will be effective. Okay. Then come to the third subdivision. Now this is relating to your interpretation of statutes. Adjustum generis concept, guys, very important. Have a look at the question. The question says the Public Entertainment Regulations Act 2020 empowers the local authority to ban cinemas, theatres, circuses, music concerts and other places of public amusement during emergencies. So there is one act. This act is empowering the local authority. They can ban cinemas, theatres, circus, music concerts, other places of public amusement during emergencies. Acting under this power, authority ordered closure of amusement parks and gaming arcades. In another order, authority also directed the closure of Private coaching centers arguing that they too are places of public amusement. Aggrieved operators challenge these orders before the High Court. Question number 1. What does adjustum generis mean? Straightforward theory. Adjustum generis means of the same kind or species. The term adjustum generis means of the same kind or species. When does this rule apply? This rule will apply only if 5 conditions are fulfilled. Condition number 1, there must be an enumeration of specific words. Enumeration is nothing but list. There has to be a list of specific words. Over here, if you see, I have a list, guys. Cinemas, theaters, circus, music, concert. I have a list. These are all specific words in the list. The enumeration constitutes a class or category. Yes, all of these specific words over here, they belong to one particular category. And what category? They are all places of public amusement. So yes, they all do belong to a category. Then the category is not exhausted by the enumeration. Yes, there are so many more places of public amusement which are not written in this list. Like for example, amusement park. Even an amusement park is a place of public amusement. It is not mentioned in this list. So number 1, there is a list of specific words. Number 2, that specific words, they all belong to one specific category. Yes, they belong to the category of public amusement, and that category is not exhausted. Yes, there are many other places of public amusement which are not written in the list. General term follows the enumeration, which means what? After these 4 specific words, I do have a general word over here. Other places of public amusement, I have written a general word. Other places, etc. and others. These are all examples of general words. So there is an enumeration, there is a list. In this list, I am having specific words. All the specific words belong to a particular class or a particular category. Then that category is not exhausted by that list. And general terms follow the enumeration, and there is no indication of a different legislative intent. What is the meaning of the last condition? The last condition means very simple, guys. The last condition says the law should not, be against adjustum generis, which means that particular law should not indicate not to apply adjustum generis. So if all these conditions are fulfilled, then adjustum generis will apply. Now, if adjustum generis applies, what will happen? Adjustum generis basically helps us to interpret this general word. How to interpret this general word? What do you mean by other places? So what do you mean by etc.? What do you mean by and others? That is what adjustum generis tells us. So if all these conditions are fulfilled, adjustum generis will apply. And applying the concept of adjustum generis, how will you interpret this general word, guys? General word will also come under the same category only. What is the category over here? Places of public amusement, right? We're talking, this whole list is about places of public amusement. So in this other places, what will you include? You will include other places of public amusement only. So will amusement parks and gaming arcades be covered in this list? Yes. They will come under other places. Other places will include every other place which is of public amusement, it will include. So amusement parks, they are places of public amusement, guys. Gaming arcades, they are places of public amusement, guys. So even these will be covered in this list automatically under other places. But what about private coaching centers? Can I say private coaching centers also come under other places? No. Is a private coaching center a place of public amusement? Not really. It's a place of education. It is not a place of public amusement. So this will not come under other places. Nicely, you've understood now. So if adjustum generis is applicable, what will happen? Nothing will happen. Adjustum generis just helps us to interpret the meaning of that general word. That in this general word, what and all will be included. Only all other places which belong to the same category, public amusement, that only will be covered. Okay. So what does the word adjustum generis mean? It means of the same kind or species. When does the rule apply? 5 conditions you will learn. Also, definitely learn when the rule does not apply. You have some 4 to 5 situations when the rule will not apply. Learn that also properly and go, even that is important. Then apply the principle of adjustum generis and advise whether amusement parks and gaming arcades can be included within other places. Yes, we just spoke about it. Whether private coaching centers will be included in other places. No, because private coaching center is not a place of public amusement. It is a place of education instead. Okay, so this was your 4th question. Now come to the 5th question, guys. Let's quickly give a reading to the question first. The question is about filing the financials with ROC. So, Accounts of Companies chapter, guys. So, the question says Bright Future Limited, a listed public company, held its AGM on 30th September 24, where its financial statements were duly adopted. However, due to oversight, the company did not file the financial statements with ROC. When questioned by the auditors, the management claimed that since AGM was properly conducted and accounts were circulated to shareholders, filing with ROC was optional. This is wrong. Once the financials are adopted in the AGM, within 30 days, right? Within 30 days of the AGM, we are supposed to file the financials with the ROC within 30 days. Company did not file, company has clearly violated the provisions. Meanwhile, Start One OPC Private Limited and OPC within the same group argued that it is not bound by AGM related timelines and therefore need not file financials with ROC. Even this is wrong. 1% company, there is no AGM. So for 1% company, we have a different time limit altogether, and that is 1% companies are supposed to file they're supposed to file the financial statements with the ROC within 180 days from the end of the financial year. So even this 1% company has done a violation over here by not filing with the ROC. Then, adding further complexity, another company, TechServe Limited, failed to hold its AGM altogether. Board nevertheless decided to file something at least with ROC and therefore uploaded only the audited financial statements. No. See, if the AGM is not held, okay, then within 30 days from the last day by which AGM should have been held, within 30 days from the last day, the company should file the unadopted financials itself with the ROC. Along with that, they also have to file the statement of facts and the reasons for not holding the AGM. Very important. Here the question says company has simply filed the audited financial statements only. Only the audited financial statements they filed. Wrong. Along with that, they should have also filed the statement of facts and the reasons for not holding the AGM. So there is a violation over here. So point number 1. Bright Future Limited listed public company. This company held the AGM, but it did not file the financials with ROC. It is wrong. It held its AGM on 30th September 24. So within 30 days, that is by 30th October 2024, they should have filed the financials with ROC. In fact, it's a listed company, so it should have filed the financials with the ROC in XBRL form within 30 days. That is by 30th October. Second point, it's a 1% company. 1% company is supposed to file with ROC within 180 days from the end of the financial year. Third point, TechServe Limited, it did not even hold AGM. In that case, within 30 days from the last day by which AGM should have been held, you should file the financial statements. Along with that, important point, along with that, you also have to file the statement of facts and reasons for not holding the AGM. Extremely important, guys. You can't file just the financials. You also have to file the statement of facts and reasons for not holding the AGM. Okay. Then comes the second subdivision over here. This is relating to LLP. Sky High LLP, engaged in aviation consultancy, was incorporated with the following partners. So the partners are Blue Jet Limited, a company. Yes, a company can be a partner in an LLP. Airlink Limited, another company, and AeroCorp Limited, all body corporates registered in India. No individual nominees were appointed at that stage. Wrong, guys. See, no doubt a body corporate can be appointed as a partner in LLP, no problem. But however, we need designated partners. At least 2 individuals have to be designated partners, guys. But here all the 3 are companies. So these companies have to nominate, they have to nominate individuals, and those nominated individuals will become designated partners. But here no individual nominees were appointed. So therefore the LLP is not even having designated partners. So there is a violation at this stage itself. Yes, we can have body corporates as partners. Yes, all partners can be body corporate, even that is allowed. But in such cases, at least 2 individuals they should have nominated who will be designated partners. They did not make any nomination like this. Hence, there is a violation. Okay. Later, Mr. Rohan and Mr. Vyom were admitted as partners, and they were also asked to act as designated partners. They gave their consent orally in the meeting but did not file any written prior consent in the prescribed form. Now, this is extremely important. Listen to this, guys. To become a designated partner, individual shall give his prior written consent to act as designated partner in the prescribed form to the LLP. It is mandatory. You will become a designated partner only after you give a written prior consent that you are willing to be appointed as a designated partner. But Rohan and Vyom, they only gave oral consent. They did not give written consent, and therefore they will not be treated as designated partner. So even though Rohan and Vyom have been admitted as partners, still even now the LLP is not having designated partners. So at this stage also there's a violation, guys. In the beginning, the LLP had 3 companies as partners. They had not nominated any individual as designated partners. So at this stage also there was a violation. Then later, even though they admitted 2 individuals and asked them to be designated partners, because those 2 individuals did not give written consent to be designated partners, those individuals will not be considered as designated partners. So even though we have admitted these 2 individuals, we still don't have a designated partner. So even here there's a violation, guys. Then, none of the partners satisfied the requirement of being a resident. Even here there is a violation, because at least one of the designated partners has to be a resident. Here they are saying none of the partners are a resident. Even this is a non-compliance. There are 3 non-compliances over here, right, guys? First non-compliance, initially we had 3 companies as partners. They should have nominated at least 2 individuals to be designated partners. They did not nominate. Violation. Then the 2 individuals were admitted, but they did not provide prior written consent, so they will not become designated partners. Again, violation. Then none of them is a resident. Even that is a violation. At least one designated partner has to be a resident. Only then it will be valid. Okay, so this was your subdivision B on LLP Act. Then comes your third subdivision, General Clauses Act, guys. The question says, ABC Private Limited was served a notice by SEBI through registered post. SEBI had correctly addressed the envelope, prepaid the postage, dispatched it by registered post on 1st August 2024. So SEBI has correctly done the posting, guys. SEBI has properly addressed the envelope, condition number 1. Condition number 2, they've prepaid the postal charges, and condition number 3, they've sent it by registered post. So if all these 3 conditions are fulfilled, then SEBI has complied with the law. It's as if the notice has been served. This is only the concept of serving by post. Right, guys? 3 conditions. All 3 conditions are fulfilled. It is as if SEBI has properly served the notice. Postman reported that when delivery was attempted, the company's receptionist refused to accept the letter saying no such notice is required. Company later argued in court, since it never actually received the notice, service is incomplete and therefore termination of lease is invalid. Examine whether the notice can be considered as duly served under General Clauses Act. Support your answer with reasoning. Also give reference to a case law to support your answer. Clearly, guys, Jagdish Singh versus Nathu Singh cases, that is nothing but if all these 3 conditions are fulfilled, okay? Even if the recipient refuses to receive the notice, over here the receptionist refused to accept the letter, right? Even though the letter is returned back with an endorsement of refusal, if all these 3 conditions are fulfilled, then even though the letter is returned again with an endorsement of refusal, it will be as if the notice has been served. It will be presumed as if the notice has been served. So they're asking us whether the notice can be considered as duly served. Yes. Why? 3 conditions are fulfilled. It is properly addressed. It is prepaid and it is sent by registered post. If these 3 conditions are fulfilled, it will be deemed to have been served. Even if it was returned with an endorsement of refusal, still it will be deemed to have been served. So, yes, the notice can be considered as having been served. Okay, then comes your question number 6. The first subdivision over here relating to auditors. So the question says, Sparkle Tech Limited, a public company, appointed Ray & Company as statutory auditor at the first AGM. So which means Ray & Company are the first auditors of the company, guys. They are the first auditors. After 1 year, Messrs. Ray & Company resigned due to internal disputes with the board. confusion arose among the directors about how the casual vacancy must be filled. So there's a casual vacancy in the office of first auditor because of resignation. See, whether first auditor is resigning or subsequent auditor is resigning doesn't matter. If the casual vacancy is because of resignation, then point number one, the casual vacancy will be filled by the board of directors. Within 30 days, they have to appoint a new auditor. And then, because it is due to resignation, we also need approval of the shareholders within 3 months, guys. So, even that point will apply. One director argued that board can fill the vacancy just like any other case. No, this is wrong. Yes, board can fill the vacancy, but we also need shareholder approval within 3 months. Even that will be one extra requirement over here because vacancy is because of resignation. Then another director claimed that since vacancy is due to resignation, it must be approved by the members in the meeting. Yes, he is right. Adding to the confusion, company CFO pointed out that since Sparkle Tech Limited had 25% of paid up capital held by state government, procedure applicable to government company should be followed. No. Government company only if at least 51% of paid up share capital is held by central government, state government, or both. Only 25% is being held by the government. So this is not a government company. So government C and AG and all not even involved over here. So the first question, who has the authority to appoint the auditor in the case? Board of directors, guys. Within 30 days, they have to fill the vacancy. Right, guys, within 30 days, board has to fill the vacancy. Then what will be the term of his appointment? Term of his appointment, casual vacancy auditor, term is till the conclusion of the next AGM. No 5 years term and all. Casual vacancy auditor, term is till the conclusion of next AGM. Whether the appointment process differs because vacancy is because of resignation? Yes. If the casual vacancy is because of resignation, one extra point is there, and that is we also require approval of the shareholders in a general meeting within 3 months from the recommendation of the board. So one extra point is there. If the casual vacancy is because of any other reason, then only board will fill the vacancy, that's all. No shareholder approval is required. But if the casual vacancy is because of resignation, then I do have this extra point that I also require approval of the shareholders within 3 months. Okay, this was a simple question relating to auditors. Then comes the next subdivision, again relating to meetings. The question says, Sunrise Limited convened AGM on 30th September 24. Mr. Arvind, a shareholder holding 100 shares, appointed his colleague Mr. Ravi, a non-member, as proxy. Yes, proxy can be a member or non-member, doesn't matter. Proxy form was deposited 50 hours before the meeting. The law simply says that the proxy form has to be deposited at least 48 hours before the meeting. Here they have deposited 50 hours before the meeting, so clearly even this is as per the law. Company secretary refused it, claiming it had to be filed at least 72 hours earlier. No, this is wrong. Even the AOA cannot change that 48 hours time limit, guys. 48 hours will remain 48 hours only. Law says the proxy form has to be submitted to the company at least 48 hours before the meeting. The member has submitted 50 hours before the meeting. Perfect compliance of the law. Company secretary's refusal is wrong over here. During voting, Arvind himself appeared and cast his own vote. You saw what happened. Arvind first appointed Ravi as proxy. Properly, he deposited proxy form with the company at least 48 hours before the meeting. He deposited. But before Ravi could vote, Arvind himself has cast his vote, which means what has he done? He has done a revocation of proxy. Do you remember learning the concept of revocation of proxy, guys? Nothing but once a proxy is appointed, after that the proxy's appointment can be revoked, guys. See, I'll show you over here. Look at this. See, the member can revoke proxy's authority by voting himself before the proxy has voted. There's a simple principal-agent relationship, guys, between the member and the proxy. So before the proxy can vote, if the member himself casts his vote, then automatically the proxy's appointment will become invalid. Ravi was offended and he insisted that he should be allowed to vote instead. No. By himself coming and voting, the member Arjun has automatically revoked the proxy's authority. So the proxy's appointment is now cancelled. Member can revoke the proxy's authority by voting himself before the proxy has voted. In the given case, as Arvind himself cast his vote before Ravi could vote, Ravi's authority as a proxy is revoked. Hence, Ravi's claim that he should be allowed to vote is invalid. Okay, so they're asking us examine whether the appointment, rejection, and respective claims are valid. Whether the appointment is valid, guys, appointing a non-member as a proxy, yes, this is going to be valid. Is the rejection valid? Company secretary rejected the appointment saying that you should file 72 hours before the meeting. The company secretary's rejection is invalid because the law is saying 48 hours is enough. Here, the member has deposited the proxy form 50 hours before the meeting, which means at least 48 hours before the meeting. So, the company secretary's refusal is going to be invalid. Then, respective claims are the claims valid? See, is Ravi's claim valid? Ravi's claim, what is Ravi's claim? He is claiming that he should only be allowed to vote. No, guys, Ravi's claim is invalid. There is a concept of revocation of proxy, and applying the concept of revocation of proxy only, before Ravi can vote, Arjun has already voted. So, when the member himself votes before the proxy can vote, then automatically the proxy's appointment is revoked. So, Ravi, your appointment itself is revoked, your authority itself is revoked. So, no, you don't have the voting power anymore because Arvind himself has voted. Okay, so this was your second subdivision. Now come to the next subdivision over here. Bright Star Limited maintains both principal register of members at registered office in Pune and a foreign register for non-resident shareholders in Singapore. Yes, guys, it is allowed. If the AOA of the company allows, then the company can maintain principal register in India containing details of the Indian shareholders, and in addition to that, company can maintain a foreign register outside India containing the details of the foreign security holders. Company, while preparing for a rights issue, closed register of members in India for 15 days. So, whenever the company is maintaining a foreign register outside India, whatever provisions apply to the principal register in India, same provisions will apply to the foreign register outside India also, guys. So, if the principal register in India is being closed for 15 days, even the foreign register outside India also has to be simultaneously closed. Should the company also close foreign register in Singapore? Yes, for the same period, yes. Also, can every company maintain a foreign register? No. Only if the AOA authorizes, only then the company can maintain a foreign register. So, two simple points only this question is asking us. Number one, when Bright Star Limited closes a principal register in India, it should also close foreign register also. Point number two may be something which might be a new learning for some of you, that can every company maintain a foreign register? No. Only that company which is authorized by the AOA, only those companies can maintain foreign register outside India. Okay, then comes the last question, the third subdivision from FEMA, guys. It has two situations over here. We have to state whether drawal of foreign exchange is permissible or not. The first one says Mr. Rohan, an Indian resident, so he's a PRI. He received employment offer in Canada and he was required to emigrate in August 24. As part of the process, Canadian authorities demanded estimated amount of $350,000 to be deposited towards his initial living expenses. Rohan approached his Indian bank seeking to remit this amount. Emigration, guys, outward remittance in emigration cases, current account transaction, schedule 3. It's a current account transaction. It's a schedule 3 current account transaction, which means you can do it with RBI approval. But here LRS, liberalized remittance scheme concept, will also apply. Under liberalized remittance scheme, you have three things: studies abroad, medical expenses abroad, and immigration. These three things under LRS, you can make an outward remittance more than $250,000 also. You don't require any RBI approval provided it is as per the estimate given by the prescribed authority. So in this question, guys, Rohan wants $350,000 for the purpose of immigration. It is as per the estimate given by the Canadian authorities, and hence even though it is more than $250,000, still under LRS he can take this remittance outside India without any RBI approval. He is allowed to make this remittance under LRS. Okay. Then comes the second subdivision. Separately, XYZ Limited, a PSU of Kerala state government, wishes to publish an advertisement in a well-known foreign magazine to showcase its new product line. Cost of the advertisement is $25,000. Come on, advertisement. Foreign print media advertisement, current account transaction, guys, schedule 2. It requires central government approval. It's a current account transaction, schedule 2, advertisement in foreign print media. It will require central government approval. If it is by state government or by its PSU exceeding $10,000, it requires approval of Ministry of Finance, Department of Economic Affairs. Here, yes, the advertisement is by a PSU of a state government. See, had it been PSU of central government, then no approval would be required. Only if it is state government or PSU of state government, only then central government approval is required. It is for advertisement in a well-known foreign magazine, $25,000 guys, which is more than $10,000. Therefore, it does require the approval of Ministry of Finance, Department of Economic Affairs. Okay, so these were all your descriptive questions. All the descriptive questions I tried arranging in this question paper as per the ICAI pattern, guys. Even in the examination, if you see, like for example, if you look at the compulsory question that we had, in the compulsory question, the first question will be from Companies Act, the second question will also be from Companies Act, but the third one will be from FEMA. Same way I tried arranging even over here. In the second question, if you see, again the first two subdivisions will be from Companies Act, third one will be from General Clauses Act. So the same pattern I tried arranging the questions. So I think we had a very good mixture of questions now. Come on, let's have a look at the case-based MCQs. How many case-based MCQs do we have? We have not many, guys. We have 5 case-based MCQs, but nice good ones. Come on, let's have a look at them one by one. Let's see how nicely we are able to answer. The first one over here says, Star Vision Limited, a listed company, decided to modernize its operations. CFO proudly announced in the board meeting that from now on, all our books of accounts will be stored only on the cloud with a popular service provider. This is a future, no more bulky files. Yes, it is allowed to maintain books of accounts in electronic form, no problem in that. Company secretary objected. She pointed out that under the Companies Act, electronic maintenance of books of accounts comes with certain conditions. Yes, there are some conditions like daily backup has to be taken, then edit log has to be maintained, or audit trail and edit log has to be maintained. Then we have to inform the ROC about the details about the service provider every year. So yes, there are conditions, but if those conditions are fulfilled, then we can maintain books of accounts in electronic form. It is allowed. ROC already reminded them last year to update the details of the service provider annually. To make matters worse, their IT head confessed that they never bothered with daily backups, assuming weekly backups were enough. No, the rules clearly say daily backup has to be taken, and annually they have to inform ROC about the details of the service provider. Meanwhile, a fresh issue cropped up. So, this entire first part was about maintaining the books of accounts in electronic form. Now, coming to the second part, a fresh issue cropped up in the holding subsidiary structure. A director of the holding company, Mr. Raghav, demanded access to inspect the books of accounts of the subsidiary company, claiming this was his legal right. He was also authorized by a board resolution, but subsidiaries management resisted, saying only their own directors can inspect. This para over here is about inspection of the books of accounts. Who can inspect the books of accounts of the company, guys? Only directors of the company can inspect the books of accounts. Shareholders can't inspect. Only the company's directors only can inspect. But however, if the company is a subsidiary company's books can be inspected by holding company's directors also, provided it is supported by a board resolution. So over here, a holding company's director, Raghav is a holding company's director. He wants to inspect subsidiaries' books, and he also has a board resolution in his favor. So yes, he can inspect. Subsidiaries management is resisting. That is wrong. He does have the right to inspect because he is a director of a holding company, and even board resolution he has in his favor. So he does have the right to inspect the subsidiaries' books of accounts. Then, at the same time, in the AGM of Star Vision Limited, an ordinary resolution was put to vote. When the votes were tied, in the absence of any provision in the AOA to the contrary, the chairperson confidently declared, "Don't worry, I'll break the tie. After all, I have a casting vote in every resolution." A few shareholders protested, claiming that under the law, chairperson cannot always exercise casting vote. Does a chairperson always have a casting vote, guys? No. Chairperson can have a casting vote, number 1, only if it is authorized by AOA, number 1. And number 2, only in ordinary resolutions when there is a tie. He can't say in every case I have casting vote. No. Number 1, AOA should authorize, and number 2, there should be a tie in an ordinary resolution. Only then he can exercise casting vote. So therefore, he is clearly wrong over here. Board is now in complete confusion. Matter has become a subject of debate in their compliance review. Come on, there are 3 subdivisions under this. Let's have a look one by one. But before that, let me make the screen a little bigger for you so that now okay. Now come on, have a look at the first question in front of you. The first question says, regarding maintenance of books of accounts in electronic mode, which of the following is correct? Maintaining on cloud service is invalid. Wrong. You can maintain on a cloud. Company must take daily backups and inform ROC annually of the service provider. Yes, this is correct. No need to inform ROC. Wrong. We have to inform ROC annually about the details of the service provider. Then weekly backups are acceptable. No, daily backups are required, not weekly backups. So answer which option is correct? They're asking option B. Then what do you think about Raghav's claim? Raghav is a director of the holding company who wants to inspect the books of accounts of the subsidiary company. His claim is perfectly valid because he is supported by a board resolution. So, what do you think about Raghav's claim? He has no right. Wrong. He may inspect the books of the subsidiary, but only if the holding company is a listed entity. No, doesn't matter whether listed or unlisted. He has the right to inspect subsidiaries' books of accounts. Yes, he has the right in this question because he is supported by a board resolution also. And the last subdivision says he can inspect only if he obtains prior approval from subsidiaries' shareholders. No, he does not require approval of the subsidiaries' shareholder. So option C. Then was the chairperson's casting vote in this question valid? See, in this question was the casting vote valid? The question says in the absence of any provision in the AOA to the contrary, which means AOA is silent. AOA is not giving him casting vote right. Only if it is mentioned in the AOA that yes, in this company chairperson has casting vote, only then he will have casting vote. But the question does not say that but however in this question AOA is not giving that kind of right to him. So therefore was the chairperson's casting vote in this question valid? No, it was not valid. So yes, it can't be yes guys. So it can't be A and D, either B or C. No, casting vote can be used only if AOA expressly permits it. Also, it can be used only if there's a tie in ordinary resolution or in a special resolution. No, it can be used only if there's a tie in OR, not in SR. In SR, casting vote has no use. No, casting vote can be used only if AOA expressly permits it, yes. Also, it can be used only if there's a tie in ordinary resolution. Option C, guys. Alright, only in ordinary resolution it can be used if there's a tie, and that too only if AOA specifically allows it. Then come to the second case study. The question says Stellar Industries Limited, a listed public company engaged in manufacture of automobile components, has recently been facing several legal and compliance dilemmas. Okay, it's a listed public company. During a board meeting, directors debated on the appointment of a cost auditor. CFO suggested that the company's existing auditor, statutory auditor, Patel and Company, could also serve as cost auditor, which would save expense. No, this is not allowed. Cost auditor and statutory auditor have to be separate. Company secretary countered that cost auditors must be appointed separately by the board. Yes, the cost auditor and statutory auditor can't be the same, not allowed. Meanwhile, Stellar Industries was also facing a penalty case in court for violation of environmental rules. Statute prescribed punishment of imprisonment for the directors involved of up to 2 years without specifying whether it should be rigorous or simple. Directors argued that in the absence of specification, only simple imprisonment can be imposed. But opposition stated that under the GC Act, court has discretion to impose either rigorous or simple imprisonment. Yes. See, the imprisonment, whether it should be rigorous or simple. If the law is silent, then the GC Act says that the court can decide should it be simple or should it be rigorous. Then the question says, Stellar also acquired land for a new plant. A condition in the state rules prohibited any heavy industrial unit within 5 kilometers from the municipal limit. Company measured the distance by road, claiming that the land was more than 5 kilometers away. Municipal authority, however, measured the distance on the basis of crow-flying distance and argued that land was only 4.2 kilometers away. How are you supposed to measure distance? As per General Clauses Act, you're supposed to measure distance as aerial distance, right guys? Horizontal line, straight line in a horizontal plane. That's how you're supposed to measure distance, aerial distance, not on the basis of roadways. And this crow flying distance is nothing but aerial distance. Okay, so the question says a heavy industrial unit within 5 kilometers from municipal limit is not allowed. So if this is a municipal limit, from this within 5 kilometers you should not be having any heavy industrial unit. Okay, so on the basis of roadways we will not care. We will care on the basis of aerial distance. So aerial distance, if you see, the industrial unit was situated 4.2 kilometers away. which means it is within 5 kilometers, guys. It is 4.2 kilometers away only. It is within 5 kilometers. So there is a violation over here. You agree with me? See, read again. A condition in the state rules prohibited any heavy industrial unit within 5 kilometers from municipal limit. So from municipal limit within 5 kilometers, no heavy industrial unit should be there. But this company's unit is situated where? 4.2 kilometers away from the municipal limit. 4.2 means it is within 5 kilometers, no? So therefore there is a violation. Company is trying to justify by saying that as per road, if you see, it is more than 5 kilometers. No, we don't care on the basis of roadways. How do we measure distance? Aerial distance only we measure. So as per aerial distance, the unit is situated at 4.2 kilometers from the municipal limit, which means within 5 kilometers, and hence it is a violation. Okay. So who can be appointed as cost auditor of Stellar Industries Limited? Same statutory auditor can't be appointed definitely. So Patel and Co. can be appointed? No. A practicing cost accountant can be appointed by the board? Yes. Any chartered accountant in practice with knowledge of costing? No. Only practicing CMA can be appointed as a cost auditor. Any officer of the company with relevant cost accounting expertise? No. It has to be a practicing CMA. Then, in the imprisonment case, what is the correct legal position? Rigorous or simple imprisonment? The court will decide. If the statute does not specify, only simple imprisonment can be imposed? No. Simple imprisonment is automatic unless court issues a special order? No. Rigorous imprisonment is automatic unless the law specifies otherwise? No. If the statute does not specify, court has discretion to impose either rigorous or simple imprisonment. Option D, guys. Option D is right. Then, is a company right regarding measurement of distance? No. Company was trying to measure by roadways. That is not right at all. So, is a company right regarding the measurement of distance? No, guys. So, either option B or option D. Can't be A or C. No, distance should be measured in a straight line on a horizontal plane as the crow flies. Yes. Distance should be measured by waterway unless the state rules specifically mention otherwise. No. Option B. Distance should always be measured aerially, that is a straight line on a horizontal plane. Okay, then come to the third case study. The question says Mr. Arvind, a Bangalore-based software engineer, often discusses tricky legal issues with his cousin Meera, a law student. At the bank counter, Arvind wondered while exchanging dollars, does FEMA really care about my loose coins and cents or only about those flashy $100 currency notes? Arvind came home thoroughly confused. Meera, do you mean even my piggy bank coins in dollars are regulated? Tell me, guys. Foreign exchange. Does it mean only currency notes? Or does it include coins also? It includes coins also. So when I say foreign exchange, when we say FEMA regulates foreign exchange, FEMA is not regulating only the currency notes. FEMA is also regulating coins. Then Arvind received sad news. His father, a person resident outside India, had passed away, leaving behind a flat in London. The will named Arvind as the inheritor. Over chai, his friends began advising. Ramesh said, bro, FEMA will never allow you to keep property abroad. Sell it off and bring the money back immediately. No. Arvind is a PRI. He is holding some asset outside India, which he inherited from a PROI. He is allowed to hold, own, transfer, invest. Remember, HOTI. If I'm a PRI and if I'm holding any asset outside India, which I inherited from a PROI, I can continue to hold, own, transfer, invest. No problem. So Ramesh is saying that you have to sell it off and bring the money to India and all. No, Ramesh, you're wrong. Priya countered, no, inheritance is totally fine. You can continue to own it. Yes, Priya is right. With regard to Arvind's piggy bank coins, what is the correct scope of foreign exchange under FEMA? Only high denomination foreign currency notes are covered, coins are not. Wrong. Foreign exchange is not only notes, also it covers coins. Only bank balance abroad, not physical currency, comes under FEMA. Terrible. Only instruments specifically notified by RBI qualify as foreign exchange. No. Coins, notes, drafts, travelers' checks, letters of credit, balance in foreign currency, all fall within foreign exchange. Yes. Yes, guys, because foreign exchange means foreign currency and it includes 4 points. That's how we had learned, guys. So, yes, foreign exchange does mean foreign currency, and foreign currency is not only notes but also includes coins. So, foreign exchange will include not only notes, it will also include coins. Option D. Regarding the London flat left to him by PROI father, which friend's advice is correct? Ramesh or Priya? Which friend's advice is correct? Priya's advice is correct, we concluded. So, Ramesh is correct? No. Priya is correct? Yes. Sharma, there is no Sharma only in this question. All are partly correct? No. So, Priya is correct, guys. Ramesh is saying that he has to sell away the land outside India. No, he can continue to hold. So, Ramesh is wrong. Priya is correct. Then, this was simple. Then come to the next question, case study 4. Star Rise Limited, a listed company in the renewable energy sector, recently held one of the most dramatic board meetings in its history. Several issues relating to share capital led to heated debates. CFO proposed issuing 100 crores worth preference shares to fund a wind energy project. One director declared, "We only need preference shareholders' permission since it concerns them." To add to the confusion, legal had claimed preference shares can't be issued for more than 10 years except for infrastructure project where the limit is 30 years. Come on, let's talk about this para. So company wants to issue preference shares, guys. To issue preference shares, we only need preference shareholders' permission. Is this right? No. To issue preference shares, we require equity shareholders special resolution. If the company wants to issue preference shares, company does not require permission of preference shareholders. Instead, company requires special resolution of equity shareholders. So here itself what they are saying is wrong. Then they are saying that preference shares can't be issued for more than 10 years. Only infrastructure projects 30 years. See, infrastructure project 30 years is correct. But can't be more than 10 years is wrong. This is for debentures. 10 years is for debentures. For preference shares, it is 20 years. Then, also, Star Rise already had two classes of equity shares. Class A, full voting rights, and Class B, differential rights with lesser dividend. Board proposed varying the rights of Class B shareholders by reducing the dividend entitlement. Class A shareholders argued they too should vote on this variation. No. Company is varying whose rights? Company is varying the rights of Class B shareholders. So to vary the rights, section 48, guys, if you want to vary the rights of a particular class of shareholders, you need to get 3/4 written consent or special resolution from that class whose rights you want to vary. So you need permission, you need consent, you need resolution of Class B shareholders only. Class A shareholders argued that they also should vote on the variation. No, wrong. Other class, we will give voting right only if they are also getting affected because of this variation. Here, Class A is not getting affected. So therefore, we will not give them voting right. No. Class B shareholders claimed only their class must approve. Lawyers were called in. Argument only got murkier. Then company issued sweat equity shares to its CTO Mr. Ravi in consideration of a server system contributed by him and his specialized services in developing a solar grid algorithm which cannot be capitalized as an asset. The finance team is split. Should both be treated as assets or should one be recognized as expense? Come on, guys. Sweat equity shares, accounting treatment of consideration for sweat equity shares. We've learnt about this in our section 54 discussion. See, again, sweat equity shares, if the employees are giving to the company an asset, then the asset has to be capitalized. It will go into the balance sheet, it will be capitalized. But however, again, sweat equity shares, if the employee is giving services, then it will become employee cost, guys. It will be an expense which will be debited to the P&L account. So in this question, the asset which the CTO is giving will be capitalized, but his services will become employee cost and will be debited to the P&L account. Finally, the board considered buying back 8% of paid up equity capital. Some directors argued that a special resolution is compulsory for a buyback. Others said ordinary resolution would suffice. Neither, guys. We neither require a special resolution nor we require an ordinary resolution because we are buying back only 8%, which means we are buying back within 10%. A simple board resolution only is enough. We require special resolution only if we are buying back more than 10%, right? Maximum 25%, but if you are buying back up to 10%, then board resolution only is required. Only if you are buying back more than 10%, then only SR is required. Right, guys? Come on, let's have a look at the questions now. On issuing preference shares, whose approval is actually required? We require equity shareholders' approval, guys. So, only preference shareholders? No. Board of directors? No. Approval of equity shareholders by special resolution is required. If the company wants to issue preference shares, precondition is that we require special resolution of equity shareholders. Option C. Then, is a legal head's claim regarding the redemption period of preference shares right? No. We said that it should be 20 years. Only infrastructure project 30 years. 10 years is wrong. So, yes, he is right. No. He is partly right. Maximum redemption period can be 10 years in all cases. No. Maximum redemption period can be 20 years in all cases. No. Because it is 30 in infrastructure cases. 20 years generally. Extendable to 30 years for infrastructure project. Option D, guys. Then, on varying the rights of Class B shareholders, which statement is correct? Only Class B shareholders must approve the variation by SR. Yes. Class A and Class B must approve regardless of impact. No, we don't need Class A's approval. Board approval alone is sufficient. No, we do require the approval of Class B, whose rights we are varying. Only Class B shareholders vote unless the variation affects Class A rights also. Then Class A must also approve. So this is a better option than A, guys. So option D will be your correct answer. Right, guys? Option A says only Class B shareholders must approve. This would have been correct if option D was not there. But option D is better. It's always choose the best answer and not choose the correct answer. So, better answer is option D. Generally, only Class B shareholders should vote. But if the variation is affecting Class A also, then Class A will also vote. Okay. Then how should the sweat equity shares be accounted for? We spoke about this. The server system should be capitalized and the service should be P&L account expense. So both server system and services should be asset. No. Server system should be capitalized as asset. Service should be treated as employee compensation expense. Yes. Both should be expensed as employee cost. No. Neither can be recognized since sweat equity is always notional. No. Option B. For the proposed buyback, which resolution is required? We said no resolution is required, only board resolution is required because it is less than 10%. SR, no. Debt equity ratio, no. Ordinary resolution, no. No resolution is required, board approval is enough. Option D. Only if you are buying back more than 10%, only then SR is required. Here we are buying back only 8%, which is less than 10%, therefore only board resolution is required. Okay, so this was your fourth case study. Now coming to the fifth case study. Crest Wave LLP, a fast growing architectural firm, had three partners, Mr. Rohan, Miss Sheila, and Blue Orbit Private Limited, a body corporate partner. Rohan and Sheila were appointed as designated partners. Perfect, guys. This LLP is having two individuals and one company as partners. The two individuals are designated partners. Perfect. Then the question says ROC issued a notice when Crestwave LLP failed to file its annual return and statement of accounts and solvency within the prescribed time. Rohan argued it is the LLP's duty, not ours personally. Only the entity can be penalized. No. See, if the LLP does any non-compliance, who is responsible for legal compliance in an LLP? It is the designated partners who are responsible for legal compliance in an LLP. In case there is a non-compliance, it is a designated partner who will be punished. So basically, guys, the designated partners are responsible for legal compliances by the LLP. In case there is any non-compliance and in case any penalty is imposed on the LLP, then for that penalty, it is a designated partner who will be responsible. So ROC issued a notice when this LLP failed to file its annual return and statement of accounts and solvency within the prescribed time. Rohan argued it is LLP's duty, not ours personally. Only the entity can be penalized. Wrong, guys. What he's saying is wrong. The designated partners, they will be liable for penalties because they are the ones who are responsible for legal compliance in an LLP. So if LLP has not complied with the law, if the LLP has not filed annual return, if the LLP has not filed statement of accounts and solvency, and because of this, if any penalty is imposed, penalty has to be borne by the designated partner only. So what Rohan is saying over here is not right. Then Auditor confirmed that Crestwave LLP had been keeping books of accounts on cash basis, while Blue Orbit Private Limited insisted accrual basis is mandatory, just like in companies. So, with respect to non-filing of annual return and accounts, what is the liability of Rohan and Sheila as designated partners. What is the responsibility, what is the liability of the designated partners, guys? They only will be liable for whatever penalty is imposed on the company. The designated partners are responsible for compliance and they may be personally liable for penalties. Yes, option A, guys. The designated partners, they are the ones who are responsible for legal compliance in an LLP, and if there is a non-compliance, whatever penalty is imposed on the LLP, for that penalty, it is these designated partners who are responsible. Option A. Then, regarding maintenance of books of accounts, which statement is correct for Crestwave LLP? Maintenance of books of accounts of an LLP. See, if you look at a company has to maintain books of accounts on accrual basis only, guys. No option of cash basis. But if you look at LLP, they have an option. They can either maintain books of accounts on cash basis or they can maintain books of accounts on accrual basis. They have an option. So LLP may maintain books either on cash basis or on accrual basis. Option A. Alright, that is it, guys. So with this, I have completed the discussion of all our 4 test question papers under the ForeQast series. Like how I've told you earlier, these are those questions which are testing you on those concepts which are highly expected in the examination, and they are those concepts which we either tend to overlook or we make a silly mistake in, right, guys? So I'm hoping this entire discussion, this entire hard work, I think we spent around 4 hours to do these 4 test discussions, but I hope it was worth it. I hope you had some new learning through these 4 tests. The whole objective of giving you these 4 tests was very simple. The objective was I wanted to show you some new questions. I wanted you to check whether you are able to apply your understanding and your conceptual knowledge in these new questions also and give answers. So I hope there was some value add. I hope these questions were like an eye opener for you. I hope you've had at least some new learnings through these questions. Right, guys? I think we've put in a very good amount of effort, guys. First, the effort was in making the questions. Then the effort was in framing the answers with proper presentation. And then the third effort was making this video, this discussion video, which I think we spent solid 4 hours. That's it, guys. With this, with a lot of happiness and contentment, I am closing this video, signing off. I hope you go and rock the exams as nicely as you can. Bye-bye.